Good morning. Welcome to the Tradier Options Summit in partnership with Cboe. Here we go again, our fifth Cboe event. We're excited. We got a great audience. We've got some great presentations. I'm not going to talk too long. We're going to get right into it. Couple just notes real quick. We will have a giveaway. We'll ask the question at the first break. It will be a true or false question. Please type in true or false in the comments. You'll be eligible for the prize, which is going to be a $500 infusion of capital into your Tradier brokerage account, plus a Nikki C's golf shirt of your choice. So if you answer the question correctly and we spin the wheel and you get chosen, you will win that prize. So stay tuned for that. Comments, we always welcome comments and questions. Please use the comment section. I beg that you be respectful and be polite. And we will try to get to as many as possible. We have a big, fun-filled, packed day. So let's get rolling. So let me bring Matt in. Hello, Matt. Can you see me?
Hello. I can.
And you can hear me too. I hope my audio is better than Dan's was.
Loud and clear. How about me?
Okay, good. So Matt, you're with Option Alpha. And you're going to talk to us a little bit about your bots and what have you. You've got 15 years experience in the industry, which is awesome. Where did you first start your career?
Actually, I started at a foreign exchange introducing broker, so on the broker side of things, and then I moved over into proprietary trading in 2008, actually the summer of 2008. So it was a perfect time for that. I got to see the market crash in late 2008, 2009. And then I moved on to other prop firms and trading my own money, and eventually kind of made my way into options. Probably about, I don't know, maybe 5-7 years ago, something like that.
Oh, great. Terrific. So we obviously know Kirk and the gang over there. So that's been awesome. Yep. Sorry to make you come out a little early. I hope you're ready. I apologize for that.
Yeah.
No, we had beyond our control that Dan was having some technical difficulties back in the office with the feed. So are you ready to rock and roll?
Yep, ready to rock.
Okay. Do you need to share a screen at all before I leave?
Yeah, give me 1 second.
Yep, just throw that in there and then we'll add it to the stream and you can have at it.
Okay, present. Hold on 1 second here. Let's figure this out. Okay.
There you go. That's the one?
That's the one. Should be.
All right. You're the man. You want to start with, you want to just let that roll through, or you're going to talk a little bit first?
Let's start at the beginning. Here we go.
Okay, I'm going to take off and I'll jump in when the time's coming up, okay?
Sounds good.
Okay,
thanks,
see you in a little bit. Soon. You bet.
All right, everyone. Thanks for being here. Thanks to Laksh and the Cboe for putting this together. We have some interesting data we're going to share with you. I think you'll be interested to see what we've gathered as far as zero DTE strategies are concerned. And let's just kind of jump into it. We have a lot to unpack, so I'm just going to start going here. So topics of discussion, we have 7 key takeaways from live zero DTE trades. Then we're going to shift gears into building an automated strategy using the data that we found. And we'll wrap up with discussing how to obtain a free Option Alpha account from our friends at Tradier. So let's go. First things first, I know we all love these, but I want to make sure that we're displaying and presenting this data in the right way. And so just kind of a brief disclaimer that all the research data here is anonymous. No personal identifiers or brokerage account information is ever used. The trade statistics that come directly from the platform include non-identifiable position details, such as entry and exit date, strategy type, underlying symbol, and performance metrics. And our research team analyzes this anonymized data to better understand how traders use our platform and share objective research insights with our community. So again, all information here is for educational purposes only and not an investment recommendation. Now with the housekeeping out of the way, let's do it. So we analyzed 225,000 live zero DTE trades and ultimately found that zero DTE trading is a fair coin flip, like most strategies. But it doesn't have to be. And there's some key points that we're going to highlight here that are going to help shift the odds and shift the favor to your side. And so we're going to take a deeper look at what the 50% of profitable traders are doing and what we can implement into a bot by the end of this presentation to watch moving forward. So the first key point here that we found is that neutral strategies are by far the favorite, with iron butterflies taking the cake. Now, something to kind of point out here, which is interesting, is when you look at the short put spreads and the short call spreads, they're about equal. And if you assume that a lot of people are probably opening these two strategies as an independent iron condor, then they're about on par with where iron butterflies are. And so it sort of further proves the point that neutrality is really what's key here for a strategy type. Number two, again, kind of an obvious one, but just pointing out that the majority of the trades are in SPY and in the Qs. The interesting point here is that all the other stocks and symbols really accounted for next to nothing as far as the volume. So regardless of popularity of any of the big tech stocks or anything like that, when it comes to zero DTE trading, they're just really not that favorable. Okay, number three. This one's actually really interesting to me, and I think we'll probably do a separate presentation just kind of on this alone. And it's somewhat kind of obvious, but the days of the week that really we found to be most beneficial to this type of strategy are Monday and Wednesday. And I think that's in large part because those days typically don't have any major news announcements. And so if there's nothing catastrophic that's happened over the weekend, no major gaps, Monday you can sort of more or less assume is going to be relatively quiet, generally speaking, a sideways day. It's not always the case, but over a large enough sample size of data, it turns out that Monday and Wednesdays are really the best days for same-day trading. So thing number four, here we go. Earlier time is better. What we see here is that getting in early is really key, and your profitability rather really drops off a cliff after about 10 o'clock or so, or even call it 11 o'clock. So we want to get into these trades early, and we want to get out of these trades early as well. Number five, again, kind of obvious, but we hear this over and over again. I know Option Alpha is a big advocate of this, but smaller profit targets, smaller trade size, those two things really tend to lead to consistency and profitability in keeping your account alive through all the ups and downs and bumps and whatnot. All right, number seven, win rate. So when you kind of package all these things together, you come to this kind of scatter plot of win rate, which is kind of right about 70%, 75%, where most of the trades land. And I think that this highlights and sort of leads into the popularity that we see and also the results that we see in a lot of the popular bots and a lot of the strategies that we have in our platform, in our exchange. And I just kind of want to highlight a couple of those just to sort of drive this point home. But if you look at our leaderboard, which is a new feature that we released with the last update, you'll see that there's quite a few of the bots at the top of the list, not just in terms of popularity, but also as far as profitability are concerned, that are zero DTE strategies. And so it's all kind of blending together. And one of the fascinating things that happened as we were packaging and going through all this data is that I sort of realized that, actually, let me get back to that point real quick. Let me preface by just sort of summarizing sort of what we learned, right? So the most popular strategy being the iron butterfly, which represents about 41.5% of all trades. On average, those profitable trades were open between 10 and closed at about noontime. And the reason that that's interesting is because a lot of people are avoiding that volatility in the first 30 minutes. And then more importantly, almost, they're closing these positions before those later hours after lunch, where you're going to run into issues with liquidity, getting out of your trades, not finding a buyer, issues where the broker's getting antsy and want to take some risk off the table, issues with assignment risk. And so the idea here is to get in and get out within a couple of hours. And so with that in mind, we found that the average return for these profitable trades was 14%. The average loss for these losing trades, about 25%. The average risk per trade, about 2,200. And I wanted to also kind of break that down into contract size. So we see that the average contract size, and this is across the board. So if your account is smaller and you don't want to trade 6.5 contracts on average, by all means, not a recommendation, but always a good idea to trade smaller size. So we just wanted to highlight that both in terms of dollar risk, but also in terms of contracts. And then just real quick, rate of return for profitable trades, 9.5. Rate of return for losing trades, 16%, we'll call it. P&L for profitable trades, 183. P&L for losing trades, 320, we'll say. And this one's actually really interesting because the average P&L per trade, whether it's a winning trade or a losing trade, is actually positive 1633. So there's a positive expectancy with these iron butterflies, these 0DT iron butterflies. And that was a really interesting thing that we didn't initially know. So now we kind of get to the fun part, right? And I know I'm cruising right through here, but I'll slow it down when we get to the bot building part a little bit. But if you're anything like me, you've been to a million of these webinars and you've seen a bunch of these slideshows, and you're probably like, okay, great, that was cool. They're colorful slides. I appreciate it. But do you have anything that can back it up? And as we were packaging this data, we got a good laugh out of the fact that I've been running a whole series of these bots that are more or less the same strategy. So this one in particular, which launched in October 2022, and it is a paper bot. So full disclosure there. We're not trying to present it as live trading, but it opens one IB at 9:45 in the morning, Monday, Wednesday, and Friday, with a 10% profit target and a 20% stop loss. And you can see that this thing has been really consistently performing. The drawdown less than 10% is amazing. A profit factor of 1.85, even with your average loss being greater than your average win, is beautiful. And best of all, you have that high win rate that everybody's after. And I think that's what draws a lot of people to the 0DTE strategy, being at about 81, almost 82%. All right. So part of this presentation, I wanted to highlight one of the key features of our platform that we call exit options. And the reason for it, well, I guess there's a couple of reasons. Number one, a lot of these strategies, these shorter duration strategies, they are incredibly difficult to deploy without the help of automation. And so Option Alpha is really invaluable when it comes to, number one, building, number two, forward testing, and number three, being able to manage these things in real time. Because I see a lot of stuff out there that is great on Twitter and it's very interesting, but if you can't apply this in real time moving forward, or it's incredibly difficult to manage, then it's just kind of noise. And so exit options we developed as a position management system, and this sort of flowed out of our community. A lot of people are after, and they like to trade shorter frequency, short duration trades. And so they needed a way, and they wanted a way where they can manage these positions. They can sort of set their profit targets, set their stop losses, and let the automation in the bot do its thing and eliminate that emotion and that kind of just angst that you have when you got to trade on, especially when it's a same day trade. So exit options are going to be a key part in our bot building, which we'll sort of shift into next. All right. So to recap, we're going to put the data into action, which is kind of my favorite part here. And just to sort of give a brief strategy overview, we're going to go with an iron butterfly. The entry and exit time is going to be 10 a.m., closed by noon. Exit options, we're going to set a 12.5% target and a 25% stop. The 12.5% is a little bit under that 14% average, so I kind of want to just keep it there. And then the schedule being Mondays and Wednesdays, and we'll set the max position per day to a $2,500 max risk. Oh, and let's, 1 second, we'll get to that after, my bad. So how do I share another tab? Can I just go like this? Can you see my bot platform? Oh, 1 second. My bad. Lex, can you jump in here? Can you see my trading platform?
Yeah. So what you can do is if you're going to share another one, then you have to let me know that, and I'll add it back to the stream again.
Okay. Yeah. So, I'd like to share a different tab.
Okay. Go ahead and do that. I see remove the PowerPoint, and then you have to add the other one.
Okay. 1 second. All right.
Let's see if this is it. Is that it?
Yep, good to go.
All right, off you
Gotta do it
go.
on time here, Lex. All right. So to the new guys especially, I'm going to try to go a little bit slower. I know I breezed through those slides, but I want to take my time just to sort of explain some of the nuances here. But what we're going to do is we're going to build that bot based on the information that I had in the presentation. So just give me 1 second here. Pull that up. And here we go. All right, so we click on bots. We're going to come over here and we're going to click on new bot. And now we have a couple different ways where you can build a bot. So you can start with a blank canvas. You can run through a bot wizard. You can clone a bot. We're going to go with empty bot. And we're going to name this cap blocks Tradier Summit 0DT. Can't type when somebody else is watching. It's a rule. And we're going to give this 25K because that's the PDT threshold. And we'll create. All right. So now we have our blank slate. And what we want to do first, we want to go in here and we just want to tailor our daily position limits. We're going to do 1 per day. Okay, because we're only opening one trade at a time. And then we're going to come up here, we're going to hit add automation. We're going to build an automation. All right, so here's a blank automation. We're just going to call this entry, or we could say entry at 10 a.m. Something like that, whatever you prefer, really. It doesn't necessarily matter. And so when you click on the plus button, you're going to get a bunch of different steps that you can add. Okay, these actions allow you to do a bunch of different things. For instance, all of these decisions, if you wanted to come in here and you wanted to proceed your open position action with checking the symbol price, checking the symbol volume, or any other properties, coming in here and assessing whether or not the market has moved up or down based on dollar percentage. There's just a lot that you can do in here. This is a whole other presentation, so I'm just going to kind of gloss over it a little bit. Indicators you can choose from and utilize. Position criteria and metrics you can use. These would be bot based. So if you want to assess your bot open P&L or how many positions the bot as a whole has, things of that nature. Opportunities would be your trading opportunity. If you want to check if that's available on the options chain, you want to check that it meets a certain reward to risk or probability of profit, anything like that. You can use these prior to opening the position, just to verify that the things that you want in place are there and you've checked for and you're assessing the market. And then we have some general ones here if you want to check for time, if today's an FOMC day, etc. So we're going to kind of skip over all that because this particular bot is pretty straightforward. We're going to go here. We're going to just go with an open position action. And we're going to go down here to Iron Butterfly. And then, so we have some position details here. The symbol we know is going to be SPY. The expiration we're going to set at least 0 days. And now if there wasn't a 0 day, this would round up to whatever's available. You can go and set it between a certain day for a specific day, or you can match it to another existing position. So there's a lot of flexibility with that. In the leg selection, I'm going to leave this just as a standard 50-10 delta. But what we're going to do is we're going to go in here and we need to make sure that these two legs, these two short legs, they match each other. So we're going to use this selection here, which is same strike as long call, but we're going to flip this around. We're going to say this is the same as the short put. And so what this does is that the short put is going to land on whatever's a 50 delta, and then it's going to ensure that the short call matches that strike. And so it keeps the Iron Butterfly strategy intact. All right, and then position size. So we could leave it at 1 contract. You could insert another value here if you wanted to. Our data shows that $2,500 risk or less is what sort of you could say is ideal. I don't know if I want to use that word, but let's keep going here. And then smart pricing. So smart pricing is also just as amazing as exit options, in my opinion. There's a bunch of different ways that you can utilize smart pricing. And just to kind of give people who are brand new, who are not familiar with Option Alpha, a brief primer, essentially what smart pricing does is it takes the spread starting at the mid to the ask, and it's going to divide that spread evenly into different price increments. Okay, and so what it effectively does is it tries one price. If that price doesn't fill, it'll cancel the order, try another one, cancel the order, try another one, and it'll work its way up to that ask price, trying to obtain the best possible price for you. And what we can do in here is not only change how many times or how many potential prices we want tried, but also how fast we want that frequency to be. We could turn smart pricing off if we just want to have one limit price. We could also submit a market order if you want to go that way. So there's a few different options here. And then within the final price setting, we could go 100% of the bid-ask spread, which is the default. If you wanted to go beyond that, you could do that as well. And one of the reasons you might want to do that is because prices move around sometimes. You could be off by a couple of pennies, and you want to just make sure that you're getting filled on that ask price. But that's entirely up to the trader. Another one that we introduced recently is a dollar-based slippage amount from the mid price. So this helps in volatile markets. If you want to ensure that you're not going too far away from the mid, you can do it that way, or you can submit just a straight up limit price at a price you prefer. We're going to just keep it with normal 100% for now. And here's where I'm going to spend some time just kind of talking about exit options. So again, exit options, they check your positions every market minute between 940 and 350. And if your profit is hit, it's going to submit an order. If you don't get filled, it'll check again in a few minutes, submit it again until you basically get filled. It's going to keep trying to meet those requirements. So what we're going to do in here is we're going to go and we're going to select 12.5%. Again, with the smart pricing, you have different options here to select what you prefer. We're going to skip the trailing stop just because we didn't have any data to support whether or not the trailing stop adds any value or not. I personally think that they're wonderful. I use them all the time, but that's not part of this presentation. Stop loss, we're going to go with 25%. And again, we're just going to leave this normal 100% bid-ask spread, but you can, of course, change this to whatever you'd like. Expected value and alpha, we're going to leave blank. And then we're going to go in here. And so as far as the expiration, we want to get out 4 hours before the market closes. And we don't have that option. So what we're going to do after this is build a separate automation to make sure that we're getting out at 12 o'clock no matter what. So we'll skip that. You could, if you wanted to, just for redundancy's sake, go in here and say 2 hours before. And that's going to, if for some reason you still had a position on, that would be a fail safe to get you out at 2 o'clock. We'll just leave it. Earnings don't matter. This is same day trading. So we're going to skip over the PTT threshold or PTT safeguard. And then this is amazing. This one actually really gets me excited. What this allows you to do is disable your exit options if the spreads get wide or wonky or whatever. And it's super helpful to ensure that the pricing at the point of exit is on par with what you're expecting, what you want. So I'm just going to go in here. I'm going to add a spread guard, and we'll just do 25. That's generally pretty good for SPY. Anything above that, is sort of, you can probably bet on is a little abnormal. All right, so save. Now, if we wanted to tag this position, Tradier, we could do that. Doesn't necessarily make a difference for this particular strategy, but that's a good way where you can analyze your trades further. You can reference your tags in other automations. There's a whole lot of utility with tags. Another feature that we rolled out recently are various entry and position criteria. And these are similar to what I showed before with the decision groups, but they allow you to just throw it all into your open position action. And this really cuts down on the size of your automations and the amount of things that you have to check along the way. You can really just, honestly, you can build an entire automation like we're doing here with one open position action, and that's it. So we're going to add bot as available capital. This shouldn't really be much of a concern, but it's always good to have. And the bot has less than one position, as it should, because it's only one position a day. We can kind of skip over these. We're not going to add any sort of VIX or IV filters at this point. And position criteria, let me just kind of let me block this off here or collapse it. Position criteria, we could check bid-ask spread. We can make sure that this is, say less than 30 on the entry, and expires before next earnings report. Won't apply to this because it's an ETF. We don't actually, I guess if it is far enough on a Wednesday, we might want to avoid FOMC, but considering we're getting out prior to noon. We're just going to kind of skip over that for now. But again, if I have extra time here, we can spin up a bunch more bots. I can show you how easy it is just to clone these, make some changes, and have a whole group of them just to test out these theories and numbers moving forward. So let's just close this out here. All right. And so we've effectively just consolidated the findings of 250,000 or 225,000 live trades into one open position action, which is pretty amazing. And so we'll save that and we'll go in here and we need to set our schedule. And essentially what this is you're telling the system, when do I want to run my automation? In this case, we know that we want to hit Monday and Wednesday mornings. So we're going to use what's called a repeating schedule, a reoccurring schedule. We're going to come in here and we're going to change this to weekly. And we're going Mondays and Wednesdays. 9:45. I'm going to bump this out to 10 o'clock to avoid any sort of morning volatility. And as far as the market holidays, we want to just skip those. We want to just completely avoid any sort of holidays altogether. All right. And so we're past the run time for this. So the little warning message just basically says that it's going to run on the next available interval. All right. So that's that. But we have one more thing that we have to do real quick because we need to ensure that we're getting out at noontime. So exit at noontime. I'm going to come in here. And we need what's called a loop. And a loop is going to cycle through or loop through all of your different positions. Okay. And we can define what we're specifically searching for and referencing. We could even throw our Tradier tag in here to make it a little more granular. And then once we've identified the positions that the bot contains essentially, we want to go in and let me preface that 1 second by checking first that the market time is exactly 12 o'clock. And then if yes, we're going to close our position. Okay. And again, bunch of different smart pricing settings. You can also use a math operator if you want. We'll get into that some other time. We're just going to leave it at 100% bid-ask spread for normal smart pricing settings. You can leave yourself a memo if you want, like, exit at noontime, and you're done. You save that, and we're going to, of course, set this as a monitor, so it'll run every 15 minutes, same as a scanner. We are going to be releasing 5-minute scans shortly, and I'm super excited about that. I know the member base, user base is super excited about that. It's really going to be a game changer, I think, for a lot of these higher frequency, shorter duration trading strategies to be able to scan even faster and make sure that your automations are staying on top of the price action as quickly as possible. So we're going to set this as a monitor here. You could also set that as a reoccurring event to run at noontime. It's entirely up to you, but just kind of want to showcase a little bit of the platform functionality. We could go in here and we could add some bot notes like, 0 DPE bot based on Tradier Summit presentation. Okay, now you know what it is. And then boom, just turn it on and it'll do its thing. And we can check on this next time, 6 months, a year from now, what have you. And we'll see how it's performed. One thing that I did set up yesterday, actually last night, was a bot of the same type, same strategy. I wanted to try and do the cooking show, pull the cooked turkey out of the oven thing. And it looks like we have actually closed our position. So now you can see that exit options came in here at noontime, or I'm sorry, not necessarily exit options, but our monitor ran at noontime and we got out. I went with a market order, but you can see that all the trade info here is part of the position details. So we made $10 on this trade, just opening at 10 o'clock and then closing with our hard time-based exit. So pretty cool. That's pretty much it. Laksh, you have any questions?
I am coming back. How are you, Matt? Good. You said you were able to kind of show another piece. You have a little bit of time if you'd like it because we had that little snafu at the beginning. Do you want to move to that real quick? Since you have a little time.
I do actually. Let's go back to real quick. We'll shift gears here.
Do you want to put that same slide back in there?
Yeah, I do actually. I'm going to go back to the slide deck here. So give Give me 1 second, and we will.
Perfect. And I do have. There's lots of questions, so we'll
Okay.
get
Yeah.
to
Sure. Yeah. If we
to
have
a few
time,
of
I
them.
mean, fire away.
Yep.
All right. 1 second.
Yep. I'll look for that to come in, and I'll share it for you. Here it is. Okay, this it?
Yep. All right. So best of all, to those of you that are new, we are running a promotion in partnership and in thanks to Tradier Brokerage, where if you connect a $2,000 or more brokerage account to Option Alpha, they will cover the cost of a Option Alpha Pro Plus membership. So it's very simple. You can log into Option Alpha. You can start a free trial now if you go to optionalpha.com/start and authorize your Tradier account on our end. Once it's qualified, the account will update automatically, and you'll get 50 bots to play with and 500 back tests per month. And so you can clone the bot that I just made, which I'll share with everybody. You can make modifications of it, 10, 15, 20, it doesn't matter. You can go and create your own strategies. You could go into our templates exchange. There's hundreds of different strategies there. If zero DT trading isn't your thing, we have long calls, long puts, long equity, leaps, and everything in between. So this allows you to not only get yourself into the Option Alpha platform, but also leverage the benefits of Tradier brokerage, their zero commission structure, and really get the best of both worlds.
Cool. Good. All right. Can we go here? Yeah. So a lot of questions. There's questions on SPX. I know you said that you guys don't do SPX. What do you think is the main reason for that?
We don't currently
nickels.
Yeah, no, we're working on it. I mean, there's some technical hurdles with the way that SPX with the pricing increments. So we're working with the Cboe hopefully to get that online. But at this point, it's something that we haven't been able to figure out. There's some technical challenges there, but certainly on our radar. We'd love to offer it, but we got to figure some other things out.
Okay, I'm going to show us a question here. This one I thought was pretty interesting. Can you see that?
Yep. All right. So question from Amit: will the exit orders are at the exchange server, or will it be executed once the conditions trigger? So we submit the orders and then we cancel them, and then we'll resubmit them. So you don't have any resting orders at the exchange. There's pros and cons to that. Some people prefer the good till canceled approach. I personally like submitting it, not resting on the order book, taking it off, reapplying it if the conditions are still true. So we're sending an automated order back and forth to the broker every time.
Got it. So if someone closes his or her computer down for the evening, do they lose those orders, or are they sitting on one of your servers? Okay.
Yep, totally held on our servers. Everything's cloud-based, so you can go about your day, go to the beach, whatever you want to do, and exit options and your automations and your bots, for that matter, are going to do their thing without you. And in most cases, it's better that way because you don't goof them up like I do.
I have tons of stories around that, so you're right. I agree with you 100%. How about this one here? I think if we need a little color on this one. So do you have implied volatility based exits of any kind?
Sure. Yeah. You can use decision recipes to reference IV.
Okay.
Yep.
Great. And you have a whole database of implied volatility stats and what have you?
Oh, yeah. I mean, if you go to optionalpha.com, I mean, there's a heap of education, research reports, you name it, blog posts. I mean, we have plenty. We have pretty much, one of every flavor, you could say. So yeah, there's info, there's articles there on IV, HV, whatever you prefer. Okay.
And then someone asked somewhere, there's a lot of comments, so I wasn't able to scroll back, but you're doing this on spiders predominantly. Is that right? SPY?
Yeah. Okay.
Any effort to move to individual stock names, or is that strategy just not as effective?
You could. I mean, the data sort of speaks to the fact that most people who are successful at this are doing it in SPY. So I was conveying and putting that data to work. Sure, if you want to give it a whirl on Tesla, go for it. Like I was saying before, Option Alpha is a software platform. You can build, you can clone, you can deploy a number of different strategy types. So, pick your own adventure. If you want to try this strategy on stocks, or you want to try an entirely different strategy, go for it. When you have 50 bots, you can very easily have bots that do one thing and bots do another thing. And I love that personally. Based on my experience, I think it's one of the real values of this platform to be able to take an idea, right, out of a presentation, put it into a bot, let it do its thing, observe it, figure out, okay, where it's doing well, maybe where it could be improved, iterate on it. And then just with literally one click of the mouse, you can clone a variation of that, change that profit target, maybe to 15. Maybe you want to not have one with a stop and you want to compare and contrast. It's insanely powerful in terms of gleaning information on a real-time forward basis, as opposed to just back testing, which in my opinion has sort of limited capabilities. I think forward testing across a variety pack of different strategies that have variances is immensely powerful.
Great. I think earlier on someone asked about the iron butterfly and how you decide to space your legs apart from one another. Any sort of commentary on that question?
Yeah, I mean, so kind of the default, and I think a standard, at least as far as most of the bots in our platform, are your 50-10 delta. You could, and I can switch back to the platform if you want, but you can set your legs in a variety of different ways. If you want to offset based on standard deviation, you can do that. If you want to offset based on a percentage, you can do that. If you want to offset based on a dollar increment, you can do that. So if you want to go, instead of being delta based, you could do, 10 wide. You could do whatever you want, really. So it's up to you.
Okay, great. So you mentioned that you have up to 50 bots and you can purchase more. Is that right? So your standard subscription has n number of bots.
So this is actually the top tier subscription. Okay. Pro Plus is as good as it gets. So we're offering through the Tradier promotion a way for you to get the maximum amount of bots, full power, full service. We don't gate any sort of features. It's all in one. So one subscription gets you all the way there. The only thing that we do is we limit the amount of bots per account and the starting capital of each bot. Got
it. This person here wanted to know that. I think you just said it, but I just want to make sure we cover that.
Yep, absolutely. You can also go to optionalpha.com/pricing. There's details there as well, but it's very simple. All you have to do, create an account on Option Alpha, go into the settings, authorize your Tradier brokerage account, assuming that you have a $2,000 minimum balance. The system will automatically recognize it as qualified and will update the account level accordingly. Usually takes about a day or so.
Okay. And there's no issues with pattern day trading. Essentially, I guess you have to cover the capital part of that if you're going to be trading frequently, right?
That's based on whatever funds are allocated or are in the trader's brokerage account. That's sort of outside of the scope of the bot. So essentially the way that it works, you provide the bot with the piggy bank, with that capital allocation. It only knows about and it's only using the funds that it's allocated. You could have $1 million in your brokerage account. It doesn't matter if you give the bot 10K. That's what it's working with, and that's what it's basing its position sizing off of.
Okay, I got it. Here's another one. I think your team might have asked this or answered this in the chat, but I just wanted to expose it to the rest of the folks in case they missed that.
Right. Exit option. Is it possible to just close shorts? Just close short legs? No, you would have to basically override the position, release it from the bot, and then you can close it separately on the brokerage platform.
Okay. So, what I'm thinking too, and this is just, I'm thinking for myself, I have 50 positions or 30 positions. I'd probably want to use this for my exit strategy on all 30 positions.
Oh yeah.
Right.
Game changer. Total game changer.
God. Total game changer. So that's where I ended up going in the latter part of my trading career was to that. And you said it early, and I want to reemphasize this, and you throw all the emphasis you need on it. The emotionless part of making a trading decision is massive.
Yep.
Especially in the off-floor world. I can't stress it enough.
Oh yeah.
And your system here is awesome for that. If you set something that you believe in and you have a good trade plan with it, whatever that is, and you let the machine do the work, man, I'll tell you, it is. I agree with you. I think it's a game changer.
Oh yeah. Once you make that shift, you're never going back. There's nothing like it. It really, not only does it take that emotional aspect out of the equation, but it's also just in terms of an organizational standpoint. When we got 50 positions on, I mean, that's a lot of legs. That's just a lot of keeping track of certain things. And so when you can just apply your exit options and then let the automation do its thing without you, I used to, when I was in the prop world, I would place a trade and then I would physically sit on my hand, right? So just hands off the mouse, don't touch it, let it do its thing, right? And I know that everybody who's ever traded has experienced this of just thinking, maybe I should just close it out. I'm just going to leave. It's probably not going to go there. And then it gets to your target, or it turns out to be a winner. It's just every single time. It's like this little gremlin that's just chasing all of us.
I know. It's much different in the off-floor world. I agree with that. Let me get a couple more here, if that's okay.
Yeah.
How long does the promotion run from Barry?
Good question. Yep. Till the end of 2023 minimum. Hoping that we can extend it beyond that, but till at least the end of 2023.
And then again, let's just make sure we make sure that this is clear.
50 bots.
That's what I thought.
Yep.
Okay.
So you can clone the one that I just built, and then you can find yourself 49 more, which is plenty.
Yeah. Do you find that in your community, are people sharing these things with one another when they build something that they find wonderful? Do they share it with the community from time to time?
Yeah, absolutely. That's the best part. The friendliness and the collaboration and the reciprocity, you could say, is amazing. Some of my best friends who I've never met are people in the Option Alpha community who I've collaborated with, who I've exchanged bots with, and I like it that way, and I hope that it always stays that way. It's certainly our intention to always have it be open and democratic, and allow people. And truthfully, I think in the future we'll probably even will develop the community in that direction to be able to facilitate collaboration amongst traders in a more powerful way. I certainly would like to see it go that way and have people who love zero DTE trading. They can group together, they can share all their zero DTE bots, they can collectively build them together and deploy them. And if that's not your thing, that's okay, because there's a different place for you. It's a very welcoming place. And truthfully, I think that's, again, one of the major benefits that is very distinctly different than anywhere else that I've seen in the trading sphere, is that there's 300 or 400 templates in the community right now that you can go clone. And they either, might have been developed by me or Kirk or Jack or any of the other members. It doesn't, it's just across the board. And we're not gating the cost for these, like you see a lot of other places where to get Lex's bot, it's $39 a month. To get Matt's bot, it's another $56. And then, Kirk's bot is $99. And before you know, you're spending $500. It's open playing field.
Yes.
You can take the ones you want off the shelf and put them in action.
Perfect. All right, one more, and we got to run. If that's okay, Matt. Let's see this. I'm not sure here if this makes sense to you.
Sure. Yeah. Yep. Absolutely. So I didn't touch on it at all, but trade ideas is an entirely other conversation, and we do use machine learning and some AI capabilities with trade ideas, which in short is. Let me start that over. So basically, trade ideas in a nutshell. We filter and we analyze millions of trading opportunities every single day to filter down and provide people with all of these different opportunities in all these different symbols that we support. And so you can go in there and you can filter it out, and you can figure out, if you want to trade Tesla today, pre-earnings or something like that, you can go in. Actually, I think that's a bad example because we actually filter prior to earnings. But either way, you can go in there and you can set, your minimum reward to risk. You can filter it all the way down to finding that one trade idea that fits your criteria and that you want. So yes, we do use machine learning and some AI inside of the back end of trade ideas.
Great. Good. Well, Matt, thanks for coming on. I'll tell you, I love the Option Alpha platform. Terrific. Great information. You had a lot of comments in there. They can go to optionalpha.com for more information.
Absolutely.
Is that safe?
Optionalpha.com. You can start a free trial, 30 days, no strings attached at optionalpha.com/start.
And then after that 30 days, is it an annual subscription or is it month to month or both or either or?
Any way in between. Hopefully they connect a Tradier brokerage account and they're rocking and rolling for free.
Okay. Awesome. Thanks so much for coming on, Matt. It was awesome. We really appreciate it.
Anytime. Good to see you, Laksh. Take care.
Have a good one. All right. Next up, another great friend of ours and partner. I had the pleasure of being with Mr. Markus Heitkoetter in Vegas recently. Let's bring Markus in. There he is. Hello, Markus. Oh, we got a volume. Let me get your volume on there. Hold on.
There we go.
There you go. Oh, there you go. How are you?
Doing great, doing great. Not at home right now, so not in my usual studio. I'm in an Airbnb, hence this weird turquoise wall with light switches built in right there.
Perfect, perfect. It's always good. We're just interested in you anyhow, so that's awesome.
Cool. No, it's great. I'm escaping the Texas heat. And you see, before you got started here, we had a bet going on what kind of jacket you will wear this morning. I was betting on green. There was some blue. There was some purple. And then you're surprising us with black. What's up with that?
You like this color. So while you're on, I wanted to kind of honor that. And I'm going with the dark color right now. Well, Markus, I'll let you get going. I don't want to take away from your time. Why not, instead of me telling the group about you a little bit, why don't you tell a little bit about you? I'm going to add your slide in here. I'm going to disappear and I'll come back on in about a half an hour and ask a few questions. Is that okay?
Cool. That sounds good. Okay.
Okay. Let me remove myself and then you have at it.
All right. So does this mean that for the next 30 minutes, I'm here unsupervised? This will not go well. Anyhow, okay. So I'm Markus Heitkoetter, originally from Germany, now living most of the time in Austin, Texas, when I'm not traveling. Right now, I'm traveling with my daughter because my daughter is an active sailor. Let me see. Can I bring in the screen somehow? There we go. So, oops, it was there and then it was gone. What do I need to do? Is that you or me? Okay. Anyhow, so that's her. That's Vivian with her skipper. And so we are traveling here to sailing events, and usually there's like 100 to 120 boats. The next event where will be 180 sailboats like this. Typically, I'm traveling in this, so we're bringing our own sailboat in this trailer. And this trailer looks so small behind this bus. This time we did not take the bus, we took the truck. So that is how we are traveling right now. And you see just the size of the trailer here. Anyhow, that is what I'm doing for fun when I'm not trading options. So today we want to talk about proven strategies to navigate volatile markets. And in order to see of what's happening here is let's take a look at the markets. I have here the S&P 500 up, and we're just looking at the last 3 years. 2021, I mean, it was just up, up and away, as we all know. Then 2022, the sky is falling. We are going into a bear market. We were into a bear market, and right now we are climbing out of this. So the question is, how do you trade these markets where you have an uptrend, where you have a downtrend, where you have a super choppy and nervous market as we had, and now going into an uptrend again? And this is what I want to share with you today. I also believe that, especially as option traders, we need to keep an eye on the VIX. And here is the VIX, the volatility index that we saw in 2020 with the pandemic was spiking. But if you look at what happened here over the last 3 years, 2021, not surprising, as we were moving higher. The VIX anywhere between 15 and I want to say 25 most of the time. Last year, when traders were more nervous, VIX values typically between 22 and 30. And right now, we are trading at lows that we haven't seen in a while, 13.43 as of right now this morning. And it's super, super interesting because today the VIX seem to be decoupled from the indices. As you can see, the Dow is up 0.3%, the S&P is up 0.25%, the Nasdaq is up 0.1%, and the VIX is up. Usually, what we see is when the markets are going up, the VIX is going down, but not today. So the question is, how do you trade these markets? Is there really a one strategy fits all? And so all I'm doing here is that I want to share my personal experience of what I'm doing, and then I mean, you test it on a simulator or whatever you choose to do. So I would like to share with you my strategy that I've been trading here over the past few years. And you're probably also interested, because I saw this in the previous presentation here with Matt, that you always want to know, okay, what are the results? What are the results? So we have a software right now where we have a trading log integrated into this. So I haven't entered 2021 yet. So 2021, I made around $160,000. And again, this was in these market conditions. And you might say, well, that's easy in an uptrend to make this kind of money. And this is in realized profits. And then here is 2022. So $156,000 with this strategy here. As you can see, most of it coming from options, a little bit from stocks, some of dividends, and this is the realized profits. And then I want to show you where I am this year so far. So I'm at $64,000, $40,000 here coming from options, $17,000 from stocks. And you might be wondering, why is $17,000 coming from stocks here? I thought that we will talk about options. Yes, exactly. That's what we are going to do. So how does all of this work? Well, what I like to do is I'm trading the so-called wheel strategy. And many of you might be familiar with the wheel strategy, so I don't want to spend too much time on this. I want to just, in the next 3 minutes, explain the basics of the strategy, but then also go into a few nuances, how I'm trading it, because it might be slightly different than you know it. And I mean, after all, you're here to just learn a thing or two, right? And if you can walk away from this presentation with just one nugget, I think it was worth spending 30 minutes together here. So how does the wheel strategy work? So first of all, you're selling cash secured puts to collect premium. That is the idea. So kind of acting as the insurance here. And the reason why this is so cool, I'll show you in a moment, of why I'm liking to do this in all of these different market conditions here, whether the market is going up or the market is crashing down or the market is going sideways and not anywhere. Volatility is high, volatility is low. I'll show you why that is. Now, let me just, before we move on, show you a very specific example. And I want to just right now take a look at Google. So here is Google. And today, Google against the overall market is slightly down here, down 0.8%. And as you can see, Google right now is trading at 122.70, and we could sell the 115 put expiring next week on July 28th. So if you're watching the recording, today is July 19th. So this means that we have how many days to expiration? A little bit over a week to expiration. So just to use this example here, so Google is trading at around 122.73. We can sell the, what was it, the 115, I believe. Let's quickly go back here. The 115 put expiring July 28th. So this is in 9 days from today, because today is July 19th. And so in order, we would collect, see how much we can collect if we are doing this. We're collecting $95 per contract, so it's trading at 95 cents. So it's $95 per option traded to do that, right? And then depending on your account size, you would size your position accordingly. So step number 2, what is happening then? And probably should say here, okay, this is step number 1. Let's see if we can move this a little bit back. There we go. This is step number 2. I hope that you're okay if I'm typing out. I'm not the biggest fan of fancy slides here, and I thought we can keep it more like a conversation, as if we sat across from a table and having here a coffee, and I'm just drawing a few things out on a napkin, right? Because as you know, whatever is drawn out on a napkin works best. This is how Amazon was founded, which is of course not true, just a rumor that I made up, but maybe it was. Who knows, right? Okay, so if on expiration day, we trade above 115, it means that the option is expiring worthless. We're keeping the premium, and all is good. We can start over again. However, and this is where for me, the fun starts if on expiration day, Google trades below 115, we get assigned. What does this mean? That it means that we have to buy Google for $115, which is not bad at all, because if you think about it, right? I mean, we're getting paid $95 per option traded. So for each 100 shares to buy Google at a discount. How much of a discount? Well, here we see it. It's a 6% discount. And this is what I kind of love about this strategy, right? So the idea is to get paid to buy stocks at a discount. So if you think about it today, and Google is trading at 122, I mean, wouldn't you want to buy Google at 115? And wouldn't you like to get paid to buy Google at 115? I like this idea a lot, right? So that is the idea here. And this is what I really like about the strategy, why this is my bread and butter strategy that I've been trading for many years here. Okay, so now the question is, okay, what do we do if we now own Google and we have to buy Google? There we go. Now this is where we start with step number 3, and this is basically we sell what every options trader is starting off with, the basic option strategy. We sell covered calls against our existing position and collect more premium. And you see, this is the really cool thing. This is what I love about it, because we collect premium right here when we're selling calls, and then we're also collecting more premium when we're here when we are selling puts, and here when we are selling calls. Again, today we only have 30 minutes. I'll give you some more resources later on if you're interested in learning more about the wheel strategy and go into more depth here. We can do this, but I probably think that most of you might be familiar with the wheel strategy, because what I would like to do right now is I want to show you my way of trading the wheel strategy. So as you can imagine, there are risks when trading the wheel strategy. And one of the risks of trading the wheel strategy is if you're getting assigned and the stock keeps dropping, right? But this is pretty much the same as if you would buy a stock and then say, okay, now the stock drops. What do? There's different ways. You could apply a stop loss, right? You could do protective puts. What I like to do is I like to average down, something that Warren Buffett likes to do. And this dude is kind of smart, and he's one of the richest traders and investors in the world, something like this, still in the top 10 of the richest people. And at age, 92, 93, 94, something like this. Dude, I think that I can do this. So if I'm in my 90s and I'm in the top 10 of the richest people, I think I did something right. So probably worth listening to him. Anyhow, so let's talk about this, of my way of trading the wheel strategy and what exactly I'm looking for. And this is where, first of all, especially for step number 1, for me, it is important to trade value stocks. Now, don't get me wrong. Years ago, I did trade growth stocks. The premiums are awesome. You got to love the premium in the growth stocks, right? But growth stocks can also fall hard. And I've learned this lesson the hard way. So this is where I have lost a lot of money. So this is why I choose to stick with value stocks. Now, the question is, value stocks, everybody is talking about value stocks. What is a value stock? And for me, there's 3 criteria. So first of all, I want to make sure that it pays a dividend, because stocks that are paying a dividend are usually value stocks and not growth stocks. So growth stocks, even Tesla to date, is not paying a dividend here. Number 2, I want to see that the PE ratio, the price to earnings ratio, is below 50, right? Because this is where often you see, if you look at weird stocks, crazy stocks that exploded during the pandemic, like Peloton or something like this, it had a PE ratio of 200, 300 or something like this. So I like to have a PE ratio of lower than 50. I want to make sure that they are profitable. And I'll show you exactly how I'm checking this, that it is a profitable company. And I actually have a 4th criteria. I want to see that the market cap is larger than $2 billion, so that I'm not dabbling in penny stocks or in stocks that are very, very illiquid here. So let me just see, before I show you this in detail, if there are any questions so far. Not? Okay, that's cool. If you do have any questions, type them in the chat here right now. We should have a few, we should have some time towards the end of the show here to answer your questions. So first of all, this is the selection criteria. So basically, right, the rule number one is, right, only trade the wheel strategy on stocks you want to own, because it can happen that you get assigned, and it can even happen that you are stuck in a trade for a while, for a few weeks, maybe even a few months. And then we get to rule number two. Rule number two, only sell puts at a strike price you want to buy the stock for. Right, so here, this is where we're going back to Google and saying, okay, do we want to buy Google at 115? And so what I personally like to do is I have this little indicator here that is showing me the lowest low over the last 8 weeks. And you see here for Google, the lowest low over the last 8 weeks was actually at 116. So the last 8 weeks is kind of like 2 months. And if you go back here, there's even the lowest low since May 12th. So it's actually 3 months. So therefore, it seems that Google has been staying above there. And therefore, you could choose that this is a good value for you, right? And so this is where I have built this little scanner. So the software that you're seeing here is the PowerX Optimizer. And this way, I can scan exactly for the criteria that I'm setting, where I say, for example, okay, market cap of $2 billion, a P ratio of smaller than 50, and I can set a bunch of these criteria here so that it comes back with a list of stocks that I want to trade. And when I do it correctly, it filters down all of the stocks that are out there, which are thousands and thousands of stocks, and brings me down a very manageable list here of 1 or 2 stocks to trade. Because here, that is, for me, I'm kind of a lazy trader, right? So I don't like to sit in front of the computer all day long. Typically, I like to watch the markets for the first 30 minutes after the open. That's what I'm looking for. And this is why I want to be as efficient as possible here. So that's what I'm doing. So just want to see about the naked puts. They are cash secured puts. And again, it's not everybody's cup of tea. You see, I have actually this 9-step process, the wealth building system here, where number 2, when you go to Ultimate Trading Playbook, you find a strategy that works best for you. And you see, this is why I say this is what I'm doing. I'm not standing here and say, you should do the wheel strategy. If you don't do this, you will lose all of your hair. Your spouse will leave you. Your kids will never talk to you, and your dog will die. No, I mean, I'm sharing what works for me. If you liked what Matt shared before, the options bots here, then do this. And we have many more presenters coming here today. And this is why I appreciate being invited to these multi-speaker events, because this way you can choose what you want to do. And this is where really take it for what it's worth. If this is not your cup of tea, I won't be offended. I promise you, it will not change my world whether you choose to like the wheel strategy or not. So that's where you go. Okay, and I see that Google is at 122. Well, I'm looking here at GOOGL, so Google, and it is at 122.44. Anyhow, so this is where I just look at the options, and then I have built this calculator in addition to the scanner, where I could see, okay, so based on my account size, I should trade 9 options. I see how many days to expiration. Let me zoom in here a little bit so that you can better see it. I see the current price. I see the annualized ROI, return on investment. I see how much the 9 contracts would get me. And if I wanted, I can place the order directly with Tradier, so I could do this. Anyhow, and I'm doing the same with calls, where I calculate, okay, how much would I make if I sold a call? So let's just go back to the overview here a little bit. So first of all, I'm doing value stocks. So secondly, what exactly am I looking for in criteria? Because the question is, am I looking for a certain delta? Am I looking for certain days to expiration? Am I looking for a certain dollar amount? Like, for example, $1,000 that I want to make for this. And this is where, for me, the most important metric is the so-called annualized RI. So let's talk about the annualized RI and what that is. So for me, as an option seller, one of the most important metrics, in addition to the annualized RI, is the premium per day, meaning that how much premium do I make per day when I'm putting this trade on. So here, as an example, this is where you see we're going back to Google, right? So Google, if I would sell 9 puts and I would make $882 divided over the 9 days to expiration, including today, since I entered the day, that's 10 days. So this means that I'm making $88. So we go back right here to this. So $88 per day that I'm holding it. And here is how I'm calculating the annualized RI. I simply take these premium per day, the $88, pretend that I would be able to get this every day of the year. And again, pretending you got to have some assumptions here. So therefore, I'm multiplying it by 360 days, because as you can see, even this option, we are holding it over the weekend. So we can include weekends in our calculation. And then I'm dividing this by the capital that is required for the cash secured puts. And this would be here $115 times 100. So this is 11,500. So if you're just calculating it out, let me see if I can do this here really quick. And what we do is I'm using my handy dandy calculator that I do have on my iPhone, and I'm taking $88 times 360. So this would be let me just see, 88 times 360, 31,000, 680. And yes, you are right. See, I think Matt said it, that all typing goes out of the window when you're on camera or somebody is watching you. Same here. I mean, math skills, basic math skills go out of the window when anybody is watching you doing some things, but you get the idea. So this is, if I take this by $115,000, yes, I will correct it. That would be around 28%. So let me just correct this, that it is correct. So here is what I'm looking for, right? So my criteria, I would like to see at least 30% annualized return on my investment, on let's say the cash needed to secure the put, right? I mean, it's not the margin from the broker, because as you know, I mean, Tradier is just charging you a fraction of this. But you just should assume that you might have to buy all of this. And so that's what I'm looking for. And based on this, I am going through this filter. So let me show you, if you're interested, some of the current trades that I'm in. And then also talk maybe, have some questions and answers. Hope that we are doing good here on time. So I just want to show you a few trades that I'm in right now. One of the trades that I entered last week was CNC. And when CNC was dropping down, I sold, let me just mark it here. I sold the 63 put, because I said, you know what, I would be okay owning CNC at $68, at $63 here. And as you can see, it is rallying today. So most likely the option will expire worthless. But you see it has a nice low P ratio of 23.66. I can look at the income statement where annually they have been growing nicely. They are a healthcare company, healthcare plans here. Even the quarterly results look good. So that's a little bit of basic fundamental analysis that I do here, where I say, okay, that is pretty cool. So this is one where it will most probably expire worthless. Now let me show you another one. CTRA, an oil and energy stock. This is where I traded it right here. You see, when it was in this range, let me just mark this range. And I was actually selling 26 puts. And as you can see, this is where I got assigned. It went down as low as 23, as you can see here. So, I mean, it dropped by what, $3, which is around 15%. And so this is why over the last few months, I was able to sell the 26 call. And therefore, I brought down my break even to 21.85. So you see right now, I'm making money on this stock, even if it would keep falling here and keep low to the lower level here. So right now, this is where I've sold calls. And so I just wanted to show you a few examples. This here was the CNC example, for example. Then for CTRA, I got assigned, and now I'm selling cover calls, collecting more premium. And as you can see, especially for this one, this has been beautiful to wheel, where I made, let's just quickly see, go over to the trading log, take a look here at CTRA. You can probably see it here. I don't know if I need to zoom in. So I collected $22,000, 433 in premium here, mainly selling calls. And this is why I'm not concerned about getting assigned. I know that this is not everybody's cup of tea, that some option traders, or I want to say probably most option traders, don't like to do. So they avoid assignment by rolling the puts, which is fine, or closing them early. So all of this is okay. Whatever you choose to do, this is why I said, here's my way of trading the wheel strategy, and I hope that this helps you. Let's see. I know that we only have a few minutes left. Lex, can we answer a few questions here and go through those? Because I do believe that there were a few questions. I mean, I can keep going for the next few hours. I mean, you spend just a day and a half with me in Las Vegas during our mastermind meeting. You know that I can talk for the next few hours, but I also want to be respectful for the next presenter that's coming up here.
Thank you.
Thank you.
Louis,
Right? Isn't it Louis?
Luis is coming. Yes, he's coming next. Yes, good. Well, thanks for that. That was awesome. Let me ask a few questions. We only have a couple minutes. Apologize for that. I try to, collect a few as they were rolling. I think you saw them as well. One of the ones I think you answered, but I just want to clarify for the group, the delta of the put you like to sell in a cash secured way is what? Is there a typical delta?
I don't care about delta. I don't care about delta. So for me, really, the annualized RI, or the premium per day, is most important for me. That's what I'm looking for. And I'm mainly looking for having or selling it at support, even if it's short-term support. So the support of the last 8 weeks, that's what I'm looking for. So I know all the Greeks. I'm familiar with the Greeks. I choose not to use them. Now, is this a great decision or not? That's up to you. It's just my way of trading. For me, the Greeks are confusing. Not just me.
Okay. Makes sense. So now I'm going to ask the next question about the call. Once you get assigned on your cash secured put, do you have a delta in mind for that, or is it another similar type premium sort of ROI?
It's a premium sort of thing. And as long as I can get 30% annualized, this is where I'm selling at the assigned price. If the stock moves already higher, then I'm trying to make some money on the stock and sell a strike or 2 strikes above the assigned price.
Okay. And then it's safe to say then, and correct me here where I'm wrong, the stocks that you tend to look at and trade in are things pretty well, stocks pretty well, and you have a certain handle on the fundamental data of this underlying stock. It's just not these crazy fly-by-nights. They're value stocks, as you mentioned, and they're things you would want to own if you're assigned. They're things that you are happy owning in the first place.
Right. And if it is just very possible to quickly share my screen, because recently Disney came up as a stock to wheel, right? And so if you look at Disney right now, I think that Disney has become more of a media and streaming company. It used to be all media or all parks, theme parks, right? But it's now more of this. But take a look at the chart of Disney. It used to be a super solid Dow company, absolutely. But now I would compare it more to Netflix. And if you see what Netflix has been doing over the past few months compared to Disney, this is where the question came, should we trade Disney? I don't like Disney that much anymore. I mean, all political stuff aside, it just seems that they are struggling while other streaming companies like Netflix are soaring here. So this is where sometimes you also use a little bit of common sense here when you're looking at the stocks and say, okay, Disney used to be something that grandma put in her portfolio and did really, really well with Disney over the years. If you go back to a weekly chart here, but you see, recently this has changed. So just keeping a little bit an eye on it and doing some common sense. I'm not going deep diving into fundamental analysis.
Okay, good. All right, great. Well, Markus, thanks. I know we're on a tight schedule. I apologize for that. So you did awesome. Great comments in the comments. There's so many of them. That's terrific. Thanks for coming, as always. Appreciate it.
Thanks for having me here. And thanks, everybody. If for whatever reason I could not address your comment, my website is rockwelltrading.com. If you want to go there, there's a contact us. You can text me. You can call me. You can shoot me an email. Just let me know. I'll be happy to answer your questions, because here, as I said, I want to be respectful of Lewis's time, because Lewis is an awesome presenter and he's up next.
All right, Markus, great seeing you. Have a great day. We'll talk soon.
All right. Thank you.
Bye now. All right, everybody. Next up, we are at the noon hour in Central Time. We have Luis Silva coming, and he's going to be talking about emerging markets and the rise of the Hispanic trader. His title. So let me bring my good friend Luisito.
Lexito, how you doing?
Buddy?
Here comes your kryptonite.
Here comes your kryptonite. Oh no, you're the man, right?
How is everything?
Everything's great. Everything's great. You ready to rock and roll here?
Yes, we're ready to rock and roll. We are going to hablar español today.
Okay, I like it. I won't understand much of it, but we'll figure it out.
We're gonna have it in English, and we're gonna have, let's say, bilingual thing, because I would like to respect your audience as well, and also, but get them to know what is the importance of the Spanish-speaking market right now.
Okay, all right. Let me bow out of here. I don't think you need any more ado. You're the man. If you want to tell a little bit about yourself, have at it. I'm going to share this. We're going to add this the screen in for you. Is that what you want to do?
Yes, please. And I'm sharing my presentation.
Kayla can do that, and then I'm going to disappear. I'll be back in a little bit, okay?
All right.
Thank you. Bye now.
Hello, everyone. Hola a todos. ¿Cómo están? ¿Cómo la han pasado? Okay, we're going to talk about the rise of the Hispanic market, because from what I see is we have been the underdog for so many years, but we're getting there, and we're getting so much importance. We are on the spot right now. So to start my presentation, I would like to talk about Latinos and Hispanics 101. Okay, what are Latinos and what are Hispanics? Just to get to know different cultures, because when, I don't know, in US, when someone referred to us, we put all together in the same bag, but we have quite a difference between, I don't know, let's put these words: Mexicans, Spaniards, Argentinians, Colombian, Venezuelans. We have quite different. So we'd like to spot those differences for you guys in order to get more knowledge. So there are 22 countries and one territory that are Latinos, but it doesn't mean they are Hispanics. For instance, Brazil is a Latino country, but they don't speak Espanol. They don't speak Spanish. They speak Portuguese, but they are our neighbors. Let's say I was born in Colombia, and we have borders with Brazil, and we share a little bit of a culture, but we speak different language. Even though we can talk to each other, we can understand each other. If we speak very slowly, they speak Portuguese. and the other way around. They can understand us if we speak in Spanish slowly. They can understand us. So we are very, very close, but we are different. So Hispanics are people who speak Spanish, all right? So that's the difference between Hispanics and Latinos. So in the Latino bag, you can put the Brazilians as well, but you have to take out the Spaniards, the people from Spain, okay? So basically, you can find most Spanish speakers in Latin America and also in Spain. And there is a country in Africa, Equatorial Guinea, I don't know how to say it in English, Guinea Equatorial, who also speak Spanish. All right, so just to get you to know and get you acquaintance with this is America for us, okay? This is America. For Latinos and for Spaniards, this is America, the whole thing, the whole continent. However, in US, you see that America is only known as United States. Actually, it's called United States of America. So that's the way. So we consider ourselves Americans. But so we have people who were born in Central America or the Caribbean or South America, but we consider ourselves America. And this is Latin America. But if we include Spain, we have to talk about Hispanic America, Hispanoamerica, or Iberoamerica, which includes Spain, right? So this is the map of the Spanish-speaking country, and you will find some very interesting facts about it. So Hispanics make up nearly 20% of the US population, according to the 2020 census. And this group by itself accounts for 51% of the new population growth. So if you want to connect with 20% of the market share of anything, well, Spanish should be around in your, in your strategies. According to Cantor, 88% of US Hispanics say that they appreciate businesses that speak to them in Spanish. So they feel more comfortable while doing business with businesses that speak the same language. So, and we see that as a signal of loyalty. So if we can share the language or the company try to make efforts to get to know the culture, we believe that we deserve loyalty. They deserve our loyalty. So even that Spanish is the common language for the Hispanics, it's extremely important to understand we have different cultures. Mexicans, our brothers from Mexico, they love tacos. I love tacos too, but I prefer to eat empanadas. Probably Chileans, they like their own empanadas, but they are different than the Venezuelans and the Colombian ones. And let's say for as a Colombian, we drink coffee, but in the south of South America, Argentinians and Uruguayans, they drink mate. That's the preferred drink. So even we have this, we share the same language, we have different cultures, nuances. And we need to understand this because when it comes to, this is the most difficult part. When I came to US, one of the biggest challenges, it wasn't to learn the language. It wasn't to adapt to the new culture. You know what the big challenge is? Fill out immigrations or fill out federal forms or forms from the government. Why? Because every time I request a credit, I apply for a loan, I do my immigration papers, they ask me for my race. And this is the most difficult part for me. Why? Because in some forms, they consider Hispanics as a race. We're not a race. We are multicultural, very diverse. We have white people, we have African-American people, we have a mix of white and black and with native people who were here before the arrival of the conquerors. So we are very, very diverse. So I was born white, but during the years I start getting darker. So that's a really, really challenging question. I have to respond every time. So to overcome this, we need to understand that in the Hispanic or the Latino culture, we have different race mix all together. And okay, we will need to go back in history to understand why we are so mixed, because the Spanish conquerors came here by themselves. Unlike the US colonizers, that they come with families. So the Spanish conquerors just mixed with the native people and the people that came from Africa. So it was a big mess. For instance, my background, I have from my mother is from Germany, and from my father is from Spain. So why should I respond to that question in my immigration form? I don't know. That's really challenging. So, and that only explains why we are so blind when it comes to Hispanics or when it comes to Latinos, because we don't know them, or you guys don't know us. So I'm trying to get a little literacy about it. Latinos are a large consumer in the US. So if Latinos were an independent country, just the Latinos in the US, we will rank 5th in the world, surpassing United Kingdom, India, France, and even Italy. So, and if we represented that, we compare to nations like Canada and South Korea, we, as an economy of the purchasing power of all Latinos together in the US will be greater, even larger than Canada and South Korea. Education, the number of people with bachelor's degree or higher grew 2.8 times more rapidly for Latinos than non-Latinos between 2010 and 2020. This is according to the US Census Bureau. United States, believe it or not, is the second largest Spanish-speaking country in the world, just right after Mexico. We have more people speaking Spanish here in the US than Colombia, Spain, Argentina, or Venezuela. So we are around 60 million people, 60 million Spanish speakers in the US. Purchasing power. So it rose 87% from 2010 to 2020. And for non-Hispanics was a 51% increase over the same period of time. So it's expected to grow to 2.8 trillion by 2026, representing 12.1% of the total US buying power. Some facts, so we are around a little bit over 60 million here in the US. That's even more than the population from my original country, from my country of origin, Colombia. We represent around 20% of the population in the US. The median age for Hispanics is right around 30 years old. The median age for non-Hispanic is 38. So we're a pretty young ethnic group, if we can call it that way. And the households are bigger for Hispanics than for non-Hispanics. Okay. Some facts: we would like to watch TV more than any other ethnic group. We would like to watch more streaming presentation just like this. That's why probably you guys have a peak when the Spanish guy is talking, because we like this type of media to get engaged with the community, to get engaged with customers, with the consumers. And also 66% of Hispanics are employed versus 59% of non-Hispanics. 50% owns a residence versus 71%. So there is a great opportunity. I'm going to talk about, just in a few minutes, all those opportunities that arise when it comes to investing and trading. Okay. More facts. So we are immersed both in the American culture and the Latino culture, and we are largely bilingual. Actually, if you go to a Spanish-speaking household in the US, you will see a mix. We call it Spanglish. So we're talking about words between English and Spanish all the time. So it's very common that you see that we talk this this very new different language we call Spanglish. Among the main emerging markets, I'm going to talk about a little bit of investment. According to the MSCI Emerging Markets Index, shows that Latin America are bringing 14.5% in cumulative gross return compared to 3.86% in the rest of the emerging markets as a group. If we consider from May 2020 to May 2023. So year to date, the largest stock indices in Brazil and Mexico are 22% and 24% respectively, which they are outperforming the US stock markets, for instance. I took this information from Forbes. They recently released just a couple of weeks ago. Investors, and this is a big opportunity for everyone, and to get Latinos more sensitive about investing, the importance of investing, especially in the long term, because only around 24% of Hispanics are investing in the stock market. Around 61% of the white US households they own some type of stock, compared to 28% of Hispanics. 49% of Hispanics don't currently own individual stocks or mutual funds or bonds or ETF or cryptocurrency or real estate. So there is a big market to approach and a big opportunity to teach Hispanic speakers, why you should invest, give them some financial literacy. Okay. In the decade from 2007 to 2017, Latinos started 50%. Remember this, we're 20% of the population, but we started 50% of the new businesses in the US. Right, okay. In 1989, and this is the most, because I'm scratching the surface, I'm talking about only Latinos in the US, but imagine there is a whole new market that represents around 600 million people out there that they don't know anything about the financial market. They don't know anything about investing in stocks. They don't know anything because there are so many restrictions. It's very difficult to transfer the money over to brokerage accounts. So imagine that we have a huge population that they don't know anything about it, but we have to make an effort to get them to know there are chances. Even if you don't want to do trading, even if you want to trade by yourself, there are chances that you could invest in treasury bonds, that you could invest in those safe type of investment tools. You can invest in index funds. You can invest in mutual funds. And they don't know about it. And most of the time, they just work 20, 30, 40 years, and they don't know that there are out there ways to put their money to grow for them over time. So this is the most biggest challenge which I've been trying to overcome. And let me tell you, I have a YouTube channel in Spanish. We talk about options mainly. We have 77,000 subscribers. And we're talking about the tip of the iceberg because more and more people are getting interested in cryptocurrency, in futures trading, in forex trading, in stocks trading. But the thing is, sometimes the lack of information or the lack of access or the lack of a way that they can communicate in their own language, they tend to go to the wrong path. So they fall into the nets of these scammers. They put the money into those brokers. I don't want to say the word because those are not brokers, those are scammers, and they disappear tomorrow. They lose their savings. So we need to make more efforts to try them to trust us, to see, you could invest in financial regulated markets. You can invest in through safer tools. You can invest in bonds. You don't have risk, but it's better than than having your money in the bank, just sitting around and let them eat it up by inflation. So there are so many options, but we need to educate them, and we need to open the door for the Spanish-speaking population, because they don't know. Yeah, and if they don't know, well, they are not going to do anything about it. So this is our mission, to get them to know there are chances and there are opportunities out there that they can explore, and they can work hard and invest, and over the years they will see some kind of return. In 2019, 30 years later, so the average American household was 32%. It jumped to 53%. Right now, I'm talking about, well, the last data I had was 2019. Hispanics invested in the stock market only 24% of us, only 24%. So look at the big jump that happened between 1989 and 2019. So it almost doubled. What if we look at the next 30 years for Hispanics? We could double the people who invest in the stock market. And they are going to bring more opportunities. They are going to bring capital. They are going to bring savings. But we need to take care of them. We need to speak to them in their own language. And when I mean in their own language, it doesn't mean necessarily Spanish, but it's get to understand the culture, get to understand that there are people out there interested in taking care of you, in take ownership of your problems, your dreams. And we are out there, guys. We are out there. So that's why we release Sigma Trade. So if we take into account the combined value of the stocks holding, so whites are, they concentrate 24% of the value as an ethnic group of the share of the total assets. But if you are right now 45 years old, 50 years old, let me give you good news. If between 55 years old and 75 years old, you can have 3/4 of the total wealth of the stock market. So if you're watching this video, if you're watching this summit, and you're thinking it's too late, let me tell you, it's not too late. Because 75% of the wealth in the stock market, 75% are owned by people 55 and older. So it's not too late. And also, this is a message for people who are younger. Hey, you should start now. You should start investing now. Because time is the most important and critical asset when it comes to investment. Time. It's not about timing the market, there is a saying. It's about the time you remain in the market. That's all I have to say, Lexito. Actually, I just want to bring awareness of the importance of the Spanish-speaking population, not only US. And like I said, we are just scratching the surface because we have so many issues and we don't have data from people who are investing out there in Latin America, in Spain, in other countries. And basically, there is like I told you one day, there is a blue ocean that people who need to get informed, get educated, and that's why we're here.
Awesome. Thanks, Luis. Can you hear me okay? Am I on mute?
Yeah, I can hear you.
Back on here. I'm mute. Good. So from a trading standpoint, you know, as you're dealing with your culture, what do you, are there certain like hurdles? And I'm kind of more interested on the option side of things. I know you teach a lot about options. Are there certain strategies that you like to present to your community that kind of makes sense? So, you know, how would you describe that? You know, from the option standpoint.
I think I will say options trading is a very new thing for the Spanish-speaking community. When I tried to learn options, I think I told you this back in the days that I couldn't find any information in Spanish, so I had to refer in English. People are getting more and more interested in iron condors. Well, they are not so good right now because of the low implied volatility, so they are not performing well. But overall, let's say between 2022 and first half of 2023, let's say until mid-May 2023, iron condors were our favorite thing. So we played with them every day, especially when XPX had the 0 DT, expirations every day. So it was
that's your go-to strategy, you'd say.
Yeah. But right now, since the market is going up and up, and we're playing with cover calls, poor man's cover calls, and put credit spreads. Yeah. Well, it depends on what's going on in the market, right?
Right. And then do you find you like to trade a broad, basket of stocks that are interesting to you, or you just stick in the indices? Specifically?
No, I mean, some people have that like affection or personal attachment with their country. They try sometimes to invest in companies that they know. For instance, people from Argentina, they ask me all the time for Meli, MELI, Mercado Libre, which is a company from Argentina. It's just big here in the, I think it's listed on NASDAQ, or banks. But you know what? When people are starting, they just go, they prefer to go for the known. So basically Apple, Microsoft, Amazon, Google, things like that.
I got you. And you trade some of those too. I know you're a big, index trader, but you like trading some of the individual names as well, right?
Yeah. I like volatility. That's my play. If I don't see volatility, man, I'm having troubles. I've been in trouble for the last couple months. So my long-term portfolio is performing just perfect. But for trading intraday is becoming more and more tough since the lack of volatility. So any name that is liquid and have volatility is my guy, is my friend.
So something like Tesla might be pretty good.
Yeah, but this is the time of the year, or the time of this cycle that, probably if you try to do something with those stocks, let's say Tesla, you think it's too late, but it keeps going up and up. So basically for the last 2-3 weeks, I've been like kind of, I don't know, on the sides, because it's crazy right now. It's very difficult to anticipate what's going to happen, because even when you see the chart, everything is set up to go down, the market keeps growing. So
right. Okay, good. All right, Luisito, I love it. Very cool. We got a little history lesson today, huh?
Yeah. We did something different today. So because all the time we talk about strategies and implied volatility and all stuff all the time. But
okay, good. All right, well, very good. We're gonna ask a question of the audience now, and we're gonna take a little break, and then we're gonna come back for the panel on AI and the future of options trading. So definitely stay tuned for that. Any other comments, Luis, before I get to the question?
No, thank you for having me. I really enjoy just sharing time with you guys.
We do too.
It's always a pleasure.
Thank you. Thanks for coming on. We'll talk later.
All right,
man. All right, here we go. We're going to take a little break here, about 5-7 minutes. And here's the question. Right, here's the idea on the question. If you are part of the correct group, it's a simple answer. It's true or false. Okay, very simple. And if you are on the correct side of this, you will be entered into the wheel drawing. If you win, you will get $500 put into your Tradier brokerage account, and one of these cool shirts that you can pick. So the question is, true or false? In a rising interest rate environment, meaning interest rates are going higher, very simply, the value of the value or price of call options goes higher. Is that statement true or false? Type in true or false into the comments. Kayla is going to take all the correct answers and put them on the wheel. We'll talk about it after the break. But for now, go get a cup of coffee or a quick bite to eat, and we'll be back in about 6-7 minutes for the panel. All right.
Trading fees holding you back? Enter the new age of trading. Most brokerage firms typically charge 65 cents per options contract. So for active traders who trade hundreds to thousands of contracts per month, these contract fees quickly add up to substantial amounts. But with Tradier Brokerage, we offer unlimited equity and options contract trades for only $10 a month. Available on web, mobile, and desktop. Start trading today at Tradier.com. Are trading fees holding you back? Enter the new age of trading. Most brokerage firms typically charge 65 cents per options contract. So for active traders who trade hundreds to thousands of contracts per month, these contract fees quickly add up to substantial amounts. But with Tradier Brokerage, we offer unlimited equity and options contract trades for only $10 a month. Available on web, mobile, and desktop. Start trading today at Tradier.com.
All right, we are back. So next we have our panel coming up, and I'm going to let the gents on the panel introduce themselves. But we're going to talk a little bit about AI and the future of options trading on this one. So I think I have a panel built here. Let's see how it all goes. Going to start adding folks. Here they come. Can you guys hear me?
Yes, we can.
Oh, good. And I think Ashok is not on the camera yet, and we're still missing one, so hang in there. Did you hear my question on the giveaway, guys?
No, I did not. Sorry.
Oh, it's okay. You're not included anyway.
We can't win anything, right?
You guys can't win anything. Sorry, not this time. All right, so let's wait. Let's wait for Ashok. I don't think his camera's on here, or he's muted or something. And we'll get started here. And you guys got all the questions I sent out. Who knows what order I go in?
Well, we were supposed to study.
No, you're not supposed to study. I'm gonna let you guys introduce yourselves too. Oh, I think I said call options. I think Dave said call option. You already own. Yeah. Okay. We'll talk about the answer to that question in a second, Dave. Give us a little bit. All right. I don't see where Paresh is here. Ashok is not on. Okay. Well, let's do this. Let's introduce you guys, and when they come, we'll have them introduce themselves. So I'll start. Jeff, you're in the top for me on the screen, so I'll start with you first, and then we'll just go down to Ryan next, and then Laksh third. How's that sound?
Sounds great.
Go, just give us a little bio of yourself and your product and what you're doing and all that kind of good stuff. Take a couple minutes.
Yeah. So you don't want me to start from when I was born?
Please, no. Tell me about your ninth place ribbons.
Okay. Yeah. So I'm Jeff Tompkins. Pleasure to be here. I'm the founder of Altos Trading. I'm actually really excited about this topic and conversation. We don't do anything specifically with AI, at least not yet, but we do develop trading algorithms, and is one of the things that we do here at Altos, which of course is a component of AI. So hopefully I can lend a little bit of knowledge and expertise on that component of it. Yeah, so we've been around for about 8 years. Have a very diverse group of traders and investors, members in our circle that are interested in AI, interested in algorithms, machine learning, and we have somewhere around 50,000 members in 100 countries across the globe, and so I'm sure we've got a diverse audience here as well. And again, just really excited to participate today.
Cool. Thanks, Jeff. Ryan, you want to go next?
Sure. Ryan Mastro. I've been a professional trader since '95, and that was back when I was actually in college. I was able to get on the floor of the Philly Stock Exchange and was down there for several years. Been involved with a lot of hedge funds and the mix tech companies through the last several years. But right now I am working at Market Rebellion, which is a education company and does basically newsletters to help those that want to get educated and learn more. And I also co-founded a company called Options Robot, which again, one of the reasons I think Laksh said, hey, you'd be really good for this panel because of the experience and probably a little bit more of what we're doing right now. That product is geared towards startup, geared towards helping our subscribers with their trading. So it's basically into automated trading strategies using and doing with smart kind of methods. So, yeah, I mean, again, I've been in this space of helping options traders specifically get educated and on their journey from the beginner all the way to the expert. So
cool.
Thanks for having me.
Awesome. Thanks. You're welcome. Great. Thanks. Laksh, you're next. What do you think?
I'm Laksh, Gandikota, Lex and everyone here. Nice to all see you virtually. Thank you for having me. I'm a technology leader. I've been in this space for over 20 years. In specific to AI, I think I'm gonna say in the last 2 years, I've been actively like monitoring and learning quite a bit. Um, in the last decade or so, I've been heavily invested in mobile space. So quite a lot of my work that I've done has been in that space. I co-founded and I'm an active investor in a company called Uplike. You all can see behind me right here. Um, and yeah, we've done some incredible amount of work in the last 3 years, and we really sort of like simplified the overall options trading for majority of our new upcoming investors. And we have actually partnered with several influencers at this point, and we created a platform in itself which will help these influencers to work with these direct investors and sort of like rally the team in making the right meaningful decisions. I'm really excited to be here today talking about AI. This is a space that we've been like closely watching, doing a lot of prototypes. I see an incredible value, but I'm excited to talk about it here today.
Great. Thanks, Laksh. Appreciate it. Ashok, last but not least, how are you, sir?
Yeah, good, Lex. For some reason, I was not able to hear, so I had to drop off and join back. Yeah.
Okay.
Everyone.
Okay, good. Can you tell us a little bit about yourself, Ashok, if you would?
Sure. I'm a computer science engineer, worked 30 years for banks, primarily in the wealth management, private banking, and retail management. But options and stock investment is a passion. So didn't find a tool like which would help design an options strategy, which will give statistically give an ability and a high confidence to open strategies which have a high probability of success. That's what our tool does. Basically, like you can design the whole strategy, like using the data going back to 2007 onwards. And if it didn't work in the past, it's probably not going to work in the future. And if it worked in the past, it may not work, but it has a higher probability, right? That's the mantra we follow and we preach as well.
Okay. Ashok, can you get a little closer to your mic? I think people are having a little difficulty hearing you. So when you speak, yeah, that's better. Okay, when you speak again, that'd be great.
Sure.
Okay, perfect. All right, so here's what we're gonna do. We're gonna go through some questions, and I'm gonna let everyone have an answer at it. But I think Ashok, you sent over some slides, and I want to make sure we cover that if that's something that we can do. Is that something that you wanted to? You can speak about?
Yeah, sure. Unfortunately, I don't have the slides in front of me.
Okay, I think Kayla can add them to the stream, and you should be able to see them on the screen. Do you see that?
Sure. Yeah, I see that. Yeah.
Okay, so we're gonna go. That's kind of the intro slide. Let's go to one more up. I think forward.
Yeah.
Okay. Tell us about this.
Yeah, I'll just put it in a layman terms, right? In terms of, what we want to do is basically put out the definitions of artificial intelligence and machine learning and deep learning and all the technical jargon, right? And but later when we go into how it is used in the trading world, then we can it's an application of this knowledge, right? So human knowledge management follows this particular framework, which is a very famous framework. And what we don't know, a lot of mistakes happen because of ignorance, and ignorance is the most challenging area to come over with, right? So when we don't know, and we have traders get into in the early stage, they have a very high confidence, they have a early success, and they think it's going to be the world like they are going to live in the next 20 years or 10 years, and then dream of money, right? But usually by the time they realize like what they don't know, they go into the valley of despair. This is where the drop of a lot of traders or investors throw the towel and go back to their passion, regular career area, right? And drop.
Let me interrupt real quick, Ashok. The valley of despair, is that when we're losing money with our trades? Is that about it?
That's correct. Yeah, that's correct.
Okay. I had a valley of despair. I'm not sure I ever got out of it one of those years, but I hope I did. Anyhow,
yeah,
go ahead.
And market being the biggest leader and guru of everyone, and it definitely throws a lot of enlightenment, and you go into a sustainability model. But once you learn from the market, right? But it's a hard way to learn. So going into the next slide, when we break that into a very simpler terms, right? Basically all these optional strategies, there are multiple of them, many of them, and the combinations, if you combine, it's very huge number. I mean, generally people try to learn a new strategy every time and try to apply all the time, right? But instead, like, I mean, you can also choose like a particular topic, master it, and going into the once you acquire the knowledge, it's basically the application of knowledge. That's where you add the skills, like be it active trading, being in the market, or following some gurus and understanding the rationale behind it, not picking up the trades what they are exactly doing at that time, but understanding why they are doing it and what made them choose that kind of a structure in that context, right? That's the application of the knowledge, like where you will develop a skill, and all this discipline and I mean proper skill and the knowledge, and will help us to generate good outcomes, which is consistent in manner. That's how you develop talent. Like. So if you go to the next one, predominantly all these two slides I try to explain, put a little bit of human knowledge management, how it works in reality, right, in the day-to-day life. But imagine the same amount of work, whatever we have been doing for, I mean, I have been in the industry for 30 years in the work experience, and whatever I have been doing or following the market and studying all of that, and the computer utilization of the tools and the modern technologies which is available, and if you look at the underlying block, it is a deep learning models which started in about 1940s, but because of lack of computational power and all the stuff, like, I mean, it didn't come into a prominence until 2000s, I mean, close to around 90s and 2000s. And starting then, it's basically a science of I mean, looking back into the data, what happened in the history, understanding the patterns, and coming back with a little bit of predictive model and a statistical model where it will put you on the right side, right? And there are different types of application of deep learning, which is called supervised and unsupervised. Basically, the difference is unsupervised is basically there is a relational aspect. Like, I mean, if I say no means it's an S, right? Not is an S. So a negative is a positive. So that's I mean, a very simpler way of talking about unsupervised. Or basically, sometimes we don't understand why, like earnings they beat the revenue, they beat the profit earnings per that is per number, but the stock went down because of the outlook, which is basically the unsupervised model. Like, right, if you don't have a unsupervised model, then you can't read that. Like, it's basically a voice or a video or image processing, or the intention behind the statement. That's what is called unsupervised. And reinforcement is basically a action feedback, like incorporating the action. For every action, there is a feedback, and when you get a feedback, I need to form a different set of actions. That's what reinforcement, and which in simpler terms, robots. I mean, the robots do that, like, right? I mean, if you take our vacuum cleaners, iRobots, and they understand if you place some, I mean, hard substance in the path, it understands and it goes around left and right, and sometimes it goes left, sometimes it goes. That's what is reinforcement, right? All of this, combined, when you have this fast, I mean, data science is also a domain of study which handles a big volume of data, like basically billions of gigabytes, and then with a human eye, it's very difficult to catch the patterns, but it can catch a lot of patterns. More importantly, what happened in the past is past, right? But what is the current context and what kind of patterns are matching to the current context, and what is relevant investment strategy against that current context and the historical pattern, right? There could be 5 patterns, but again, we need to build this, AI model, which will be closely related to a scoring model. If there are 5 patterns that are relevant to the current context, which is more applicable, which has a more statistical probability, or which has a more high range of success, right? That's the in an essence, like that is what is data science accomplishes, which is a bigger umbrella of artificial intelligence, machine learning, and deep learning.
Okay. Perfect. So let's go back to us. Guess who's here? There he is. Paresh made it. Hi, Paresh. You got to unmute yourself. All right. So great. Thanks for that, Ashok. Now, guys, the other panelists, you guys have any Any comments on that? Did it make sense? So, let me know what you think there, if you have any opinion there.
Yeah, I think Ashok sort of like covered many of the points, especially when it comes to the technology aspect of AI. So machine learning in itself is a major component to it, and data science is another major umbrella. So that really reinforces many of the things that I've learned in the past few years. So thank you, Ashok, for sharing.
Yep. So let's explain in some layman's terms a little bit. Defining what qualifies as AI versus automation, and if there's no difference, then say there's no difference. Jeff, I'll start up with you in the top. Do you have any thoughts on the conversation around AI is huge now, right? Is it different than automation, or is there much more involved in your opinion? So I'll just ask each one of you that flavor.
Yeah, so I think that automation is a component of AI. It's an interesting question because I think there isn't just one type of AI trading. I think there are kind of different models that can meet that mold. But I think kind of my understanding of AI as it relates to trading is it combines quantitative trading, algorithmic trading, automated trading. So I think when you kind of combine all of those, and then it meets some of the criteria for artificial intelligence, that's really what we're talking about. That's I think kind of thing. And interestingly, I saw something recently that something like, just if we're just looking at online trading, so like online U.S. equity trading, it's estimated to be somewhere around a market value of $12 billion by 2028. And interestingly, a lot of that growth that's expected to happen over the next 5 years is being attributed to AI. So I think that's an interesting question, because how do we quantify that? How do we determine what volume of trading is attributable to AI and what qualifies as AI? But I also recently saw an interesting statistic that that algorithmic trading right now, whether that be AI based or not, accounts for about 65% of U.S. equity trading volume today. So it's obviously a huge component of the markets, and so I think that question is a good one, because how do we define it? What qualifies as AI? But I think those are the things I would say.
Okay, Ryan, you want to take a stab at this one?
Yeah, I mean, I guess I would approach it a little bit differently. So the way I look at automation is you're really trying to tell a computer what to do, right? You have a path of goals, and if this, it does this. So you're trying to set this automation kind of steps up. And I would say for most retail traders, they don't even have access to that yet. True automation, where you can build a plan out for 6 months of what I want this thing to do. And then you get into AI, and I look at, I've always, I've gone from the gamut of going through trade stations as a retail guy and learning all how do I put trades in and find trades and find signals and indicators that I'm going to use, to why am I making that decision? And I think when you start to think about it from that perspective, why am I doing a certain trade for a certain reason? And you're saying, okay, I may have different variables that I've based my opinions on. And I think when you start to look at it from an AI perspective, as a human, we can make these decisions on all this historical data that we have, but what a computer can do is take all those variables and throw all these different types of variations on those variables, up, down, all the way around. And as we already talked about, that context, where are we in that context right now, and comparison going backwards. Now, what I may look at in my experience may be slightly different what the computer is seeing, because maybe they have a larger data set. So I think the problem is, automation is great, and I think that's where most retail traders will find their sweet spot. And from a retail thing, I don't see many of us getting into the ability to truly use AI yet. It's there. I think we're close to that, but I think there's probably a lot of institutions that are trying to embrace it and trying to see how they're able to use these models, and and encouraging a model to take as much data as they can, give me the signals, give me those variables. What are the key variables and what are the tweaks? So they're not only getting output from an AI right now, they're trying to let it to make decisions based off of those variables. And again, the end goal is profitability. So they're trying to show and see what's making it profitable. How's it making these decisions and getting information out of it right now. I haven't seen any full end to end where they're just giving it free reign to run. Say, all right, go trade a boatload of money yet. So
Right.
I do think that's coming. I do think we're very, very close to that.
Okay, good. Thanks, Ryan. Laksh, you want to take a stab at this one? What qualifies as AI versus, automation?
Sure, yeah. I think in the past, I think all the systems that were put in place were mostly rule-based engines, which primarily what it does is you're able to put something like if then. So those systems are really good at executing those kind of rules and sort of like not predicting per se, like automating some of those functions for you, but it comes with its own challenges. It lacks the context. But AI, on the other hand, is incredibly powerful to have that entire knowledge and the context to sort of like give you out some meaningful signals for traders or in options trading or alike can look at those signals and quickly react to those and make some informed decisions.
Okay. Thanks, Laksh. Hello, Paresh. You're here.
Hey, can you hear me okay?
I can hear you okay. Did you
Okay.
hear the question? So the question is, what
Yes, I did.
qualifies as
I did.
AI versus automation? So have at it, Paresh.
Well, so Lex, I think, AI is all about data and trying to sniff out patterns from the data, right? That's what the neural networks that are underneath all the AI, that's what they do, right? AI is like a black box that's taking the data and coming up with some kind of a program that says, okay, I've got, defining, basically establishing the rules from the data. So that's really the core of what AI is. And to what Laksh said, right? There's rule-based trading, and the question is, are we going to come to a point where the AI actually comes up with the rule-based trading? That's the interesting question in my mind, because automation, there's automation with very hard rules, but it's not generalized where, okay, something new, the AI will come up with something new, right? Rules based is kind of fixed, So I think that's the essence of what artificial intelligence is really about,
Okay,
So,
great. Thanks. Ashok, do you want to add some more, or do you think you covered a little bit earlier?
I covered, but I just want to add one thing. I mean, high successful rate in identifying the pattern and matching the pattern. Second is like if you follow the rule-based and the AI model and implement it to its trueness, then you are following, incorporating the discipline into the trading system, right? And generally, if it is not your money, then you can incorporate that discipline very well. But if it's your own money, then that's where the emotion comes in, and that's what the AI can change. Like, I mean, you can pretend that model success rate, and if particularly as if it's not your own money, if you practice that discipline, it helps in that area. Thanks.
Okay, good. Thank you. Let me throw a question up here for the group. Can you guys see that?
Yeah.
Okay, who wants to tackle it? Anyone want to take that one?
Can you put that up again?
Yep. So the question is, are machines learning or people learning and reprogramming or training the computer? So, I think that's a pretty decent question. I know there's facets that once a human teaches the computer something that it can move beyond that. Any thoughts on that one? I thought that was kind of an interesting comment.
So, yeah, Lex, let me take a stab at it.
Okay.
There are, in the human mind, it's very difficult to establish a nonlinear patterns, and with programming, right, there is something called neural networks. So in the node management, if every pattern has a node, and a node has n combinations, once we go beyond 3 or 4 nodes, then you need a pen and a piece of paper and establish all of that and paths and you get lost as a human knowledge, right?
Mhm.
But what programmers does is like they do a mathematical model against matching the patterns within those nodes, and the nodes are basically the facts from the data points what comes across, right? So Dave, you are right. The programmers are helping behind the computer to learn the model and establish a model from the data, but the programmers are not doing anything specifically. We are not hard coding okay, this is what you need to do, right? I mean, it's based on data nodes, what you get, facts, and they're establishing the neural paths between the nodes and let the computer spit out the patterns.
Mm-hmm. Okay, makes sense. Okay, let's go to question number 2. I'll kind of combine these two. So Ryan, I think I'm gonna start with you if that's okay. We'll just keep kind of snaking around the group here. So first part of this, what are some of the potential benefits? I know we touched on some of this, but what are some of the potential benefits and shortfalls of incorporating AI into options trading strategies and just options trading in general? And on top of that, what do you think we can expect at the retail level from the AI, sort of push here? That's a mouthful, I know. Sorry.
Yeah, so you're basically asking benefits and drawbacks. So obviously benefits. Again, I think there's a couple different things to dissect here. One is, why are you getting into a trade, right? That's what it comes back to. The end goal is always profitability and making money. So I think where AI really starts to come into play is, can an AI system, as we talked about, patterns, more data recognition, be able to decipher this in a better way through, again, any different type of analysis that it wants to do. Now, if we allow AI, the more power that we can give it, the more we can teach it, the more we can help it through all these predictive modelings, through all the different machine learnings that we can give it. Yes, coming back to your prior question, I do feel like the programmers are learning along the way, because the AI is going to keep spitting out new things. Well, and we're trying to always figure out, how did it calculate this if it's not something that we're looking at? And how did this become profitable? What is it using for those bases of decisions? There goes a dog barking. Sorry, but I think from a model perspective and from an AI for options trading, there's components that I would say from a retail perspective that most people, and I've educated thousands, that they don't truly comprehend the actual model. So you start to play into an implied volatility where most people don't look at implied volatility. The AI will take all these things into consideration. Are these options cheap? Should I be buying more of these? Or are they too expensive? I shouldn't be buying as many. So that it's doing theoretically should be doing all of the work, building in that discipline, building in position sizing, building in profit potential through predictive measures, using probabilities where humans can't just do all these calculations in your head. I mean, me as a pro guy thinks I'm pretty good, but I'm not as good as a computer in terms of doing all that measuring. So I think the benefit's going to be that it can find those answers, and not only in the speed, because it can take all that information and do it instantaneously. Whereas I'm going to do it, and it's going to take me probably a couple of minutes to try to analyze a position and say, okay, I can see where implied volatilities are. I can see where my stock is. I can see where I think it's going to get to. So it's going to do all that information much quicker. The downside of basically putting these into place right now is, I think it's going to exaggerate the movement of the market, and it's going to go where it reaches thresholds. So it's going to get to an extreme. It's going to push things, I think, beyond where a normal trader would, but knows where its model is based off its threshold. So if, let's say, I have a plus minus of my threshold in a computer system, it's going to keep buying until it reaches a certain threshold, or maybe the option gets too expensive. And I think in that normal model where we as a retail trader would look at the given market, this is going to be so fast, it's going to move things extreme. And I think those streams are going to get wider and wider. So I think what could end up coming, if we do actually unleash AI into the market, is probably the widening of our bid-ask spreads from a market maker perspective, right? So what we see as a retail trader could get a little bit wider, because things do get a little bit more volatile, right? So that's what I'd be a little bit nervous about right now. But on the flip side of that, from an institution side, they're going to be happy. I think we're going to have this almost a battle of AIs, because the market makers, that's what they're going to deploy is, okay, I know where my extremes are. I have my business sense and saying, okay, I can sell that extreme volatility and I want to play that game. So I think we're going to have a learning curve. If they ever truly deploy this into a environment, there's definitely going to be a learning curve of, what those thresholds are.
Mm-hmm. Okay, good. Thank you for that. Laksh, anything to add there? And I can repeat the questions if you'd like.
Yeah, can you repeat the question one last time?
Yeah, so the benefits and drawbacks of incorporating AI into options trading, number one, and then and what to expect around retail trading and AI.
Perfect.
Yep.
I got it. So I think from a retail standpoint, I think artificial intelligence and we at Uplick, we've been carefully looking at how we can leverage this for our consumers. I think part of the challenge that we are seeing is the user experience and how do we present this to our users. And if you have to think from that perspective and think backwards, you will start seeing a lot of different aspects to this AI. Mostly so far up until this point, what we have seen with ChatGPT and every other systems is a question and answer, a chat interface that would communicate with you. And it's a really large language model. Essentially, it's just giving out some information back at you based on the question that you're asking. It's you need to know what to ask. So from a retail standpoint, what I really look at this point is these large language models or this AI is going to be more like a research assistant. So in options trading, what consumers would be hugely benefited from is being able to ask an intent, such as, okay, this particular stock, I'm intending to do certain action on it. And then this agent would be able to do a lot of research on the user's behalf based on the current news, trends, market information, be able to present a meaningful report instantaneously or near instantaneously for these consumers to be able to react to and make appropriate decisions.
Great. Thank you. Paresh? You're on mute, Paresh. Sorry.
I think Laksh has hit it on the spot there with the UI is going to be the most important thing to AI being used in options trading. Hey, I'm really interested in risking $500 and figuring how I can leverage $500 to take a position in Apple. What do you suggest? That's, I think, a huge, that would be very fascinating, I think, in the retail space. Yeah.
Okay. Ashok?
Yeah, only two points I would like to add, Alex. Humans get tired, computers don't get tired. And another
Come a little closer to the mic, Ashok.
Yeah,
Having trouble.
humans get tired and computers don't get tired, right? In Ryan's example, he's looking for patterns, and Ryan might get tired by 5 o'clock or maybe 10 o'clock, right? Computers can work all around. So that's one difference. Using the AI for that's advantage. Also, when you look at the doctors nowadays, they're using robots in surgeries. That doesn't mean you don't want to get a surgery without a doctor, right? So that's where we are right now, and it's premature in terms of automating 100% yet, but future may be there. But at this time, like Laksh said, pattern matching is where research assistant is where you can use it, and the recommendation of the right strategy based on the study is what you can use it. But still, a human element is necessary right now at a retail level.
Okay. And Jeff, sorry, you see how I'm snaking around here, right? You got to go first.
Yeah,
now
no
you get to
problem.
go last. You get to hear everyone now. That
There's
works
a
out
benefit to
great.
going
Right?
last. Yeah, you get to hear
That's
everybody
right.
else's response. So I could just say ditto. I echo everything.
There you go. You could do that.
Yeah. No, I think those are all really great points. I think Ryan made a great point about reducing research time. When we talk about AI and its applications to a specific market, I think the options market is a great thing to apply it to versus, let's say, equities. Options obviously are much more complex, and so I think using AI to, if we look at delta, gamma, theta, vega, right? Those are constantly changing, and they're changing very rapidly, and a human can only take that information in and process it and then act on it so quickly. So I think there's a big benefit there. I think there's potential benefits to reducing costs for firms. I also manage a hedge fund, and there's a lot of overhead expense within fund management that could potentially be replaced by AI if it's able to, do a lot of these repetitive tasks that employees of firms, hedge fund firms and things are doing. And if it's able to learn that and do that, I think that's also a benefit. So I think those are all good points. I think there's definitely benefits, especially as it relates to the options market and the complexities of that. And then, of course, as far as downsides, I don't think, kind of like Ryan alluded to, I don't think we have enough experience with it to see what the true downsides might really be until it's really used, on a more widespread basis. So.
Right. Let me post something again here. Another comment. I think it might be the same gentleman, but have a read at that. Anyone can respond to this. You guys got it?
Yeah.
Okay. Go ahead. Who's that? Paresh, is that you?
Yeah, I can go. Yeah,
Go
I mean, yeah, pattern recognition is not AI, but AI does pattern recognition really well, right? That's its core function. So I think what's interesting is how can you use the technical analysis data, because AI is all about data. I keep coming back to that. It's all about the data. So how do you take the data and then make the data kind of create an AI engine that can extract, whether it's trading strategies or a language model that you can ask intelligent questions. That's going to be the more interesting thing. Yeah.
Okay. Anyone else have a thought on that one?
Also, just a little addition, Lex, is the pattern, the technical analysis uses only the technical data, the indicator type of data, but AI can use all kinds of data, like including what's been on the news as well, like what is the impact and inferences from the news or rumors. All of that, the patterns come from that as well. It can combine that along with the technical analysis and become a holistic patterns. That's the big difference between both.
Yeah, I was actually going to say that exact same thing. I think that's where I think it really gets interesting, because up to this point we've largely referred to technical analysis, but when we look at fundamental analysis, and which is of course also rapidly changing, if we can in some way incorporate AI to take news outlet information or other types of information and then combine it with technical analysis, I think there could potentially be a big benefit to that as well. So it's not just technical patterns; it's also fundamental data, macroeconomic data, all those types of things.
But isn't that also the benefit and the failure? So we could assume, okay, how much data can we give it? How many news sources can we give it? How much sentiment can we give it? Right? It's okay. Maybe I have a feed over here that doesn't give the full picture, and everyone else has a better picture. So it comes back to, okay, in the ideal world, we can feed this thing with, infinite number of sources, then it's probably going to do really well with trading and finally be able to build a true thing. But right now we can't do that, right? That's not something that's possible to say, okay, I'm going to give it all the sentiment and, all the sentiment from Twitter or all the sentiment from all these different feeds of who's investing in why. So, that to me is, I don't want to say the problem. It's, obviously if you start to understand, statistical analysis and you start to say, okay, what is my population? How do I make these predictive natures out of that data set? So it's about how much data can you give it, as we talked about, how many patterns can you pull out of it? But I think the additional side of that is you're always going to have new things that come into the picture. And I'll give an example is a model. If you had said what it's been a couple of months now, whatever it's been since we introduced our 0 DTE options, right? That's added a whole nother layer into very short-term options that has made the market more volatile. And the market has actually been more volatile during this period because we're now adjusting to higher gamma in the near term, which we haven't seen as much. And all of that spectrum of options trading, which was, I would say, diverse over a longer duration, is probably in the shorter term. So now AI has to take all of that information into consideration as well. So we're always going to be throwing curveballs at as we go in the future. But again, to me, it's about how do we pull that data in and feed it with as much information so it can make a better, more higher probability predictive model.
Great. Let me send something up here again from Dennis. Anyone believe that? Anyone, in agreement? What do you think?
I'll just say, I'll kind of reiterate what I said earlier. I think from an AI perspective, I don't know if it's going to be that you have to trade against AI. I think you have to look at it from a couple different ways. There's going to be an institutional side where the desks are trying to make their own money. There's going to be a side where institutions are using it to make markets in the option space specifically. They're going to be able to use this to make markets and have their own predictability of what's happening with price, what's happening with implied volatility. So I would say, for the most part, I think we're going to go through a learning phase. As Jeff kind of highlighted, there's going to be this kind of learning phase to what's going to go on, because we don't truly know what the impacts are going to be if we truly enable an AI kind of model. And is everyone going to have in their back pocket, oh, go make me money? Well, then that doesn't work. It's the same thing as all of us just saying, okay, we're all going to go buy, right? Because we know what we're doing. But to me, I think there's always going to be a marketplace, but I do think it could get a little bit more volatile in terms of the learning space before we truly can kind of figure out the impacts of it. You think about it, we could have hundreds or thousands of AI machines battling against each other, and it's just like retail traders trading against each other. So I think it depends on what data is coming in on those different models. So we could have all these different models battling against each other, and that would be the marketplace, right? And I think there's always going to be availability for the retail trader.
Okay, good. Anyone else?
Yeah. If I may quickly add, I think from a retail trading standpoint, the huge value that AI can provide is that research capability of these large language models. They are really good at processing these large volumes of data. And from a retail standpoint, this is really huge, where retail investors can just ask for a quick research on a company or a ticker, and then ask it to present the right, at this moment, the state of where this company is going. That kind of information is hugely valuable for investors. So I think from a retail standpoint, I feel asking the right questions to these AI would be super critical and important. And I think that that's going to be a huge game changer for retail investors.
Good. Yeah. Okay. So one of the prime examples, I guess, maybe, I could be totally wrong about this, I'll just ask it. It has nothing to do with trading, but isn't one of the greatest AI sort of topics and experiments is full self-driving? For like a Tesla, for instance, isn't that kind of the height of this whole AI experiment of sorts? I mean, I don't want to get too deep into that question, but I'm just thinking about going, God, can you imagine being a Tesla driving on its own? It has to have all this sort of data that's totally pattern recognition and just recognition. Is that accurate or not so much? Ashok, you're shaking your head. What do you think?
Yeah, no, it is accurate. It is. That's why it's also an early stage, right? They have been working for years, and there's also a lot of analysis paralysis, like Ryan said. We can keep going on, and there are hundreds of sets of AI models that programmers are feeding the data. Basically, what you feed in, the output becomes as good as what you are feeding in, right? If you feed in garbage of data, then without doing a noise cancellation and outlier identification, or sometimes you want to identify because you don't want to be, your model is a negative logic for hedging, where you don't want to be, right? So that's what, as retailers, I think it's not ready for a retailer usage yet in a trading world in true sense for options, but at least in the next 5 to 10 years, that's the emerging patterns where you will see a lot of volatility, and where the investors, the stock investors, my father used to buy stock, hold it for 20 years, 10 years, right? That's gone. And nowadays, if you're holding it for a year, that's gone. That's where you need to know, have enough knowledge, and keep a watch on what's happening in the industry, and at least use it as a options, as a hedging if you are buying stock. I mean, if you are not investing heavily on the options trading strategies, right? At the least is that. But pretty soon, like there will be tools out there, up like Orion or some other tools like which where you put in a ticker and they will give you a report, right? That's how you can learn. Like.
Okay, got it. Good. Okay, so
if I can quickly
please go ahead, Laksh.
add a viewpoint there, Lex. I think the Tesla example that you just brought up, and I want to call out the important aspect of Tesla's success, especially when it comes to autopilot or the autonomous driving, is the data that they were able to capture over the years from all the folks who had been driving Tesla. So they captured all of that data and then they trained their model to be able to understand and react to these several different situations. So I think with the same use case, if you ask me, I think in the trading world, what is going to really happen in the next few months or days, I would say, is all the historical data that has been created for in the financial space, all of that data is going to be continuously trained by these different companies to sort of like come up with a really interesting patterns. I think the context is super important here. And I think there are several other factors which would really influence to predict any sort of market movements. But I think AI would still, again, if I have to, I'm repeating here, I think AI would be really good at providing some good research and then being able to present data to in a meaningful manner.
Yeah. Okay.
Can I add one more thing to that in terms
of Ryan, please.
The Tesla side of things, right? Tesla's feeding this visual data set into that autonomous kind of vehicle. So they're trying to picture the world that's out there. Now, obviously, there's so many different factors, and you think about this of, okay, light and glare and all these different things, and maybe we can't see in the visual eye, but they can see in the computer that they're trying to. Again, the amount of data is phenomenal. But think about it if you want to improve that model. Think about saying, okay, I want to go to the next step. Well, they don't use LiDAR right now, but what if they start to? Right, that would just enhance that to the nth degree. That would probably be rock solid because it gives them a whole nother data set of information that they can now overlay and learn from to say, okay, this is going to improve this so much more. So I think in the combination of AI, it's again comes back to those different streams of how much information can you feed it, and obviously, is there any other information that can improve the model, right? Can improve the decision making. So I think that's something you always got to be thinking about. And, we talked about sentiment. We talked about from the investment side, we talked about sentiment. We talked about fundamental data Jeff brought up. We talked about the technical analysis, the historical part of that. So the more information you can feed into any kind of decision making, again, not something a human's going to be able to do in an instantaneous second, the better off we're going to be, or better off the AI will be.
Yep.
Lex, I have something to add here.
Please.
So, the full self-driving is really interesting, and to what we all know that the data is coming from the actual drivers driving the car, and that's how the full self-driving is improving. But what was really interesting in my mind as a math physics guy was when Google taught the rules of the game of Go to a complete, like they didn't give any data, they just gave the rules. And then the Google DeepMind engine figured out how to play Go, and no human can beat that machine anymore, completely from the rules. So in my mind, I think one of the interesting things is, are we as humans so emotional about trading? Are humans going to be the right data set? Or should we just teach, say, here are the rules for trading, which is don't lose money, don't risk this much. Can AI come up with a trading system on its own? See, in my mind, that is not something that is going to happen in my mind, and we've been doing some experiments along those lines, which I'd be happy to share at some point in the future.
Okay. All right. Yeah. Good. Well, guys, good, Jeff. Go ahead. Sorry, Ashok. Say that again.
Might not be the humans might not be the right people for driving as well.
That's right.
That's true. I think there's a time where we'll be like, oh, look,
Yeah.
there's humans on the road. We don't want to go on the road anymore.
Yeah. Yeah, I got replaced by a computer
Talking
too.
of Tesla, talking of Tesla, I mean, that might be one of the reasons why the FSD failure, the full service driving failure, and the pilots not going through, behind the pricing strategy, dropping the prices, sending more cars out, and the new cars that are coming out on the road have more sensors than the previous one. So that means they are collecting more and more data. And so they didn't drop the price for a foolish reason. And they actually are buying a free data, which is improving the better FSD model, which will make more people buy the FSD model. Because it's very difficult to compete with that kind of model, any other company competing, right? Fundamentally, Tesla is in a good position. Maybe it's volatile stock, but when I buy always Tesla, what I would do, I will always buy a put option when I buy the stock. I mean, I never bought a Tesla without a put option. This being options panel, we would strongly encourage that one.
Love it. Thanks, Ashok. All right, guess what, guys? The time is up. That went fast, didn't it?
Yeah.
And I wanted to get to another point. I'm just going to toss it out there. We're not going to be able to respond to this, but I want to, think about it for maybe next time. My thing with AI and any sort of this machine learning is I want something that's predictive. Okay. I already know I can already look backwards and make a decision. What I can't do is look forward. Right. So I'm hoping that, maybe there's some ability to do that, especially when it comes to implied volatility. I know there's models out there that do that now. Is it AI based? I'm not sure. But I would love to have something that can take the whole data world and make predictive sort of, educated predictive sort of suggestions for especially in the trading. It's always related to trading, right? And we tried to model that back in our pro days. We tried to do that, and we were successful in places, and we had massive pitfalls because we don't know nearly what's known now. But that's kind of interesting to me as well. So great having you guys. Thanks for coming on. A lot of comments in here. We couldn't get to everything. We're stuck on this time thing, but appreciate your showing up, and we will chat later. I'll send you guys some emails, but thanks for coming on the panel. It was awesome.
Thank you.
Thanks for having us, Lex.
All right, guys.
Thanks, everyone.
See you
Take
guys.
care.
All right. Guess what time it is? It's time to spin that wheel. So I don't know how many trues there were, how many falses there were, but the answer is true. So the question was, in a rising interest rate environment, what happens to the price, the price of a call goes higher. That is a correct statement. When interest rate rise, so do calls. So that if you put true, you're in the wheel. And I've got to share my screen to do the wheel. Let's see if I can do that. I'm going fast. Who knows where this is, but let's see. Hang on. Let me pull this out. Okay. Trying it again. I'll get there. Don't worry. It's tough working on one computer. No fun. All right, here it is. I think I'm sharing the wheel. Kayla, am I sharing the wheel? Probably a thumbs up somewhere. And we're going to spin this baby. Are you ready? So exciting. All right, let's make it go big here. Hold on. All right, here we go for the trues. The spinner and the winner is Eli Olu. I'm not sure I'm saying that right. ELIEOLU. If you are here, please send us a little note in the chat. Say yay or something. That would be wonderful if you could do that. So I'd appreciate it. Cool. All right, we're going to take another break, 5 minutes, and we are going to be back with Mr. Rob Hocking from the Cboe in about 5 minutes. So we'll see you in a second.
Are trading fees holding you back? Enter the new age of trading. Most brokerage firms typically charge 65 cents per options contract. So for active traders who trade hundreds to thousands of contracts per month, these contract fees quickly add up to substantial amounts. But with Tradier Brokerage, we offer unlimited equity and options contract trades for only $10 a month. Available on web, mobile, and desktop. Start trading today at Tradier.com. Are trading fees holding you back?
Welcome back. We're back. Sorry, we're running a couple minutes late. We're going to go to Rob in a second here. I think we're going to try to spin the wheel. We didn't get a response from the last time, although I'm seeing something that's me. Oh, okay. Do you guys see that? So it looks like Ely is a YouTube user. So let's hold off on that. We'll decide that in a sec. All right, coming up next, I'm going to bring in Mr. Hocking from Cboe. Hello, Rob. How are you?
Hey, Lex. How's it going?
Good, man. Everything good?
Yeah. Thanks for having me. I appreciate it.
You're welcome. So we're moving right along. Sorry to keep pushing, but man, they get me on a tight schedule here. I'm 2 minutes over, so don't worry about that. That's not your business. So Rob, I'm gonna let you do the kind of the intro to yourself. You know yourself better than I do. So do a little of that first, and then I'll let you get right into it. So, and I'll jump out if you need any help with anything. Let me know. Are you going to share a screen?
Yeah, I will. Let me see. I think I got it figured out. It looks like it's easy enough down here to present.
Yeah, just share it, and I'll add it to the stream, and then Caleb will kind of move it in and out as needed.
This says I have no slides. What does that mean?
Uh-oh.
Did it need to get loaded in here somehow?
No, I mean, just if you have your computer, just hit the present button down below, and then you got to, you can either present a window or a whole screen, wherever those slides are lying.
Sorry, guys. Anyway, while we're doing this, Rob Hocking, Senior Vice President, Head of Product Innovation here at Cboe, really in charge of designing and creating a lot of Cboe's tradable products. So today, hope to go through some of the kind of presentation we've been talking about with regards to zero DTE and a lot of the data that we have and kind of that new trend in the marketplace, followed by talking a little bit about one-day VIX and kind of why and how we came about it. Still, I think I have too many screens open on my computer.
Do you have two screens or just one?
I have two, and I can't seem to find it. Oh, here we go.
Yeah.
Hang on.
Yeah, move it to the second screen, and you can share that second screen. Let me pull this in and see if that's it. There it is. Is that it?
There we go.
You're in business. All right, Rob. Perfect. I'm gonna jump out here and let you go. Okay.
Excellent. Thanks, Lex. Okay. So, hi everyone. As U.S. option markets have really seen significant growth over the last couple of years. A lot of that's been fueled by commission-free trading, and what we've seen as of late, greater position turnover, really due to shorter investment time horizons. And so in particular, options that expire on the same day they're traded, or as everyone's referring to them, zero DTE options, have led the charge in products such as the S&P 500, or better known ticker SPX. So historically in these products, and you think back to when Lex and I were cutting our teeth in the market, investors would really initiate positions using third Friday options. And then you would look to actively roll exposure. A lot of times that roll would come either monthly, maybe quarterly, depending on your strategy. And you would roll that exposure from quarter to month. But as market timing around these strategies has really steadily been evolving over the last 2 decades, and that timing change has really driven Cboe to introduce new products around it. And so we introduced Many years ago, we introduced weekly options, which I'm sure many of you are familiar with, in 2005. And then again in 2016, we furthered that by the introduction of Monday, Wednesday expiries. Now that allowed, basically that roll to move from, call it quarterly, maybe monthly, down to weekly, and then call it Monday, Wednesday, Friday. You could start to roll around certain events that happened in the market. Now we completed the complex last year when we rounded it out to add Tuesday and Thursday expirations. So now it was possible to trade options really that expire every day of the week. And this is really, as we've seen, explosive growth coming from this, and it's really served a need that the investment community was looking for. And so you can see from the chart on the screen, we've seen these volume, while the volumes have both, increased in higher percentage and shorter term. So if I even looked at one of the stats I threw up there, in fact, in 2010, as I was talking about, 59% of the total SPX trading volume came from options that expired over 30 days. But now in 2023, we're seeing a staggering, call it 43%. That's this light blue section here in the bottom right of the bottom box. 43% of the total SPX volume is now initiated on the day of expiration. So a pretty staggering shift. Ooh, sorry, a little quick on the trigger there. If I move to the next slide, I think it's important to note that while the zero DTE options make up north of 40% of SPX flows, this explosive growth has not really come at the exposure of other tenors. So all SPX continues to benefit from this overall increase in volumes. Kind of the idea of, rising tide raises all ships. And so as you can see from this chart, in January of 2021, volume and options expiring greater than 4 weeks was approximately, call it 30%. On a total volume that's closer to 1.3 million contracts a day, ADV. So that call it 4 week or bigger bucket made up approximately 400,000 contracts a day. But as of March of 23, while the overall percentage of volume that's in that 4 week bucket has dropped, we see 22%. That 22% is now on a much bigger total volume ADV of closer to approximately 2.8 million contracts. So that 4 week bucket has actually gone from, call it 400-ish thousand contracts to 600,000 contracts, showing that while the overall percentage decreased, we continue to just see more use of SPX options from the entire complex, even though I think most are focusing on this zero DTE piece just because the growth has been so explosive. So now, as the time horizons for trades has decreased, so has the size of the order that we've seen come into the market. Kind of makes sense. So I think a lot of overall more orders, but smaller in size. And this chart just goes to show kind of how that impact has happened over time since January of 21. So this is really, reflecting investors today want more precision in how they're managing risk. And as I mentioned at the start, the index options used to be a larger, more blanketed risk management tool. So if you had a long, let's call it exposure portfolio, you could buy downside optionality, and let's say over the course of a month or a quarter, you had that protection and you could roll it and move it. And that's really how you managed risk. I like to think of it as like, buying a quarterly insurance policy on either your car or home. You bought that insurance over the course of a month or a quarter, and that was just typically how you managed risk. But while, that blanketed insurance policy was effective, it's also in some instances, required you to pay more for the insurance than you maybe necessarily needed or wanted. So for example, what if you owned a classic car, let's say that, and it sat in your garage during the week while you went to work, and you only pulled it out on the weekends to go to cruise night or what have you, go get dinner with the family. So what if you could buy insurance that covered your car only on the weekends for a fraction of the price of buying that call it that insurance for a longer period, let's say for a quarter or a year? Wouldn't make a lot of sense if you're never going to, leave the garage with the car during the week. then great. You can spend less money, still be covered for what you wanted in particular, and you had much more granularity around how you bought your insurance. That's really exactly what daily expirations have done for the options market. Now you can pinpoint the exposure you want on the day you want it. So let's call it, there's a Fed announcement on Wednesday. Great. I can buy options that expire on Wednesday, covering myself for that event and spending less premium to do so, since I'm now not buying other days that I don't necessarily need the optionality for. So this change in risk management granularity is really what's driving many in the industry to say, zero DTE, it's one of the most significant shifts in the options landscape in the last 30 years. This ability to really change how you trade and manage risk across the volatility term structure has provided a lot of utility for investors, hence the explosive volumes that we've seen, which has been pretty exciting. So now, if I move forward with this monumental shift, such as, this market will now demand ways to, let me take a step back. As we start focusing more on this very short dated part of the curve, and as the volumes explode, we've gotten a lot of demand for now ways to measure it. So, how do we look at, what the market is pulling out of that information flow in this short dated part of the curve? So as volumes grew and volatility bounced around, many started to look at the VIX index to get a sense for what moves the market was pricing in. However, the VIX index was never really designed to capture that market's expectation for volatility. Specifically, VIX looked at volatility over the next 30 days, which now in today's market, feels almost like a lifetime away. Everybody's looking at, like I said, 40% of the volume in SPX, or over 40% of the volume in SPX, is trading the day of expiration. So looking at a volatility indicator that was looking at volatility 30 days from now, obviously didn't fit exactly what people wanted. So you started to see reports, things like the VIX is broken, because the moves that we saw in the 30-day VIX index didn't really match what we were experiencing as the market moved and as we traded kind of this daily time horizon. So this makes sense, right? The VIX, as I mentioned, it's 30-day calculation. It uses options, and it's using the volatility from the options that expire, call it 23 to 37 days to maturity. So it's of course not capturing this over 40% of the volume that's trading in zero DTE. And if I were to extrapolate that out, I think we have north of 50, almost 55% trading inside of 2 days to expiration. So once again, huge amount of volatility information coming out of the market there, but the VIX isn't capturing it. So we got a lot of inbounds for, yep, we understand that the VIX isn't broken. We understand that it's actually not capturing what we're looking for. We need a new measurement that will capture these moves. And so enter the 1-day VIX, or VIX1D. So this index works very similarly to the 30-day VIX. It still aggregates weighted prices of SPX calls and puts. We use a wide range of strike prices. Only this calculation uses a blend of options that have either 0 or 1 day to expiration. So 0 DTE or 1 DTE. So at the start of the trading day, the volatility number you see is almost 100% weighted on the options that expire that day. And as that day progresses, we begin to shift the weighting of the index to the following day, giving us this constant maturity, what we're calling 1-day measure of volatility. Now, with anything that deals with volatility, and especially on a short time horizon such as this, there are some nuances to the calculation that I just want to make sure everybody's aware of, and really how it differs from this 30-day VIX number. One, the index uses business time rather than calendar time. So what we are looking at is the actual 405 minutes that make up the regular hours of a trading day. So in Chicago, call it 8:30 to 3:15. or on the East Coast, 9:30 to 4:15. That is the time window that we're looking at. Why did we do this? Well, we did it this way because now we're really trying to grab that volatility information and the volatility or the expectations in volatility over the time horizon where the most activity is happening. So really the most activity, vast majority of trading is taking place during regular trading hours. So we thought it was very important to really only look at that window when we were capturing this information. Because if we spread it out over a complete 24-hour period, you can think a lot of the weighting would have come during market hours where there just wasn't a lot of activity, kind of watering down the impact of what was happening during the actual trading day. So that's one big difference, whereas the 30-day VIX uses a calendar day calculation. So second, because of how time decay affects volatility on the day of expiration, during the last hour of the trading day, we hold constant the volatility of 0 DTE options. So you can think that the weighting of those options in the calculation continues to, the weighting of those options continues to decrease and shifts more and more to the following day or the next day options. But the volatility of the 0 DTE options for that last hour remains the same. So you can think of it as if the at the money call had a 20 volatility at 2:30, or sorry, at 2:15, then for that last hour, we're going to hold that 20 vol constant. We found that in our back tests, doing this really most accurately represented the volatility the market was pricing in for that next business day. Because with T in the denominator of the calculation, you can understand how as you get closer to expiration, that time decay factor can really explode out of volatility. So we didn't want that noise in the calculation. So we effectively just hold that constant on the 0 DTE part of the calculation. So you can think of the one-day VIX as almost 100% weighted from a weighting perspective on 0 DTE options at the start of the day. And then as the day progresses, that weighting shifts to next day options. So that by the end of the trading day, now the calculation is almost 100% based on the following day's options. And that just continues. And that gives us that kind of constant maturity, one-day volatility measure. Now, as with anything, there have been some critiques on how we went about designing the one-day VIX and how this time decay element affects the calculation. And, I will agree that the time decay element does add some nuances, but the only way to eliminate that is by really not using 0 DTE options as part of the calculation. And so we didn't want to do that. Really much, almost all of the feedback we got was for a measure to capture where all of this volume was happening, where, call it this 40+% of the volume was trading. And so in order to do that and really capture this exact part of the curve, we had to deal with kind of this decay factor and nuances in the short-term volatility measure. So that is why a lot of what we did, that's kind of the theory behind or kind of the backing behind why we did it. And so now that I've explained kind of the why, we can go through now and let's take a look at VIX1D and really how it compares to the VIX itself that you might just be more familiar with. So as you would expect, the one-day VIX is more volatile. Now, when I say that, it's not just more volatile as in terms of an absolute number, like, hey, VIX is 15, therefore VIX1D is 20, but rather it's more volatile both to the upside and to the downside, which makes sense. I even think back to the first day when we launched this. We launched it on April 24th. When we launched it, it was called just an average Monday in April. Not a lot going on. The index, I think, launched right around a 9 vol level. And this was at a time when the VIX was closer to 17. I think it was 16, 17, somewhere in there. And so I initially, and rightfully so, received a bunch of phone calls the minute we launched and asking if the calculation was working right, because I think people had really anchored themselves to this idea that, wow, a one-day number is going to be more volatile. And it was just that, as we looked at it, it was just that nothing really was going on that day for the next 24 hours. So you looked at April 24th, kind of to that window of April 25th, nothing was really going on. So the actual one-day volatility number was quite low. So now as the week went on, the index continued to move higher. And I think it peaked on Thursday of that week, the 27th, and it peaked around 15.5. And really that was because on Thursday, the US released a preliminary estimate for GDP. And that preliminary estimate at the time just added uncertainty to that 24-hour window that the one-day VIX was pricing the market's expectations in. So it just captured that, okay, we're moving along, nothing today, nothing tomorrow. We're starting to creep up because there's a GDP estimate coming out on Thursday. It kind of captures that pop. And then if you were to look right after that, you start to see the index decline again, because the following day, once again, looked just more like a typical day. So as you can see from this chart, the red line is the 30-day VIX and the blue line is the one-day VIX. So the one-day number has both higher peaks, as I talked about, and lower troughs, really as expected. And this just reflects, call it the binary uncertainty that comes and goes in the market surrounding different market events. And so if I finish up here on the last slide, I just wanted to really show and further look at kind of the correlation between the 30-day and one-day number. So as you can see on this chart, there is a positive correlation. We call it around 0.5. But really the level of correlation ended up being what I would call a lot lower than I initially expected when we started kind of going into the back test and designing this product. Intuitively now, when I think about it and kind of dig in, it makes sense. As I mentioned, one-day events tend to be very binary in nature. And once the event happens, it's known and it gets immediately priced out of the market and you move on to the next potential event. And depending on where those events hit over the course of, a week during these one-day slices, you can have obviously a big difference to, say, a 30-day VIX that acts more as, call it a market trend follower. So are we expecting more uncertainty in the overall market? For example, as inflation spikes, as the interest rates began to climb, it introduced a lot of uncertainty into the market, and that overall level of VIX, as I've heard some of the panelists talk today, you saw that number creeping up over that, time horizon when that was going on. Call it, the end of 2022. And so that makes sense. You see the 30-day VIX level rise, but, as the Fed runs out of room to hike interest rates and inflation somewhat starts to slow, you now have a series of rate hikes where you feel like, okay, eventually they got to slow down here. You start to see the VIX creep back in because it's more of that trend follower. That initial uncertainty really gets priced out of the market. And so now you start to see that creep back in. But this idea that the one-day VIX sits around just what's happening in the next 24-hour window really dislocates from that idea that it's that 30-day VIX market trend, one-day VIX, call it almost close to close look at what volatility looks like. And so that is where this kind of call it 0.5 correlation comes into play. And so at that point, Lex, I think that's pretty much all kind of I had. Happy to, give a little Q&A here if anything's popping into the line.
Yep. Thanks, Rob. That was great. So, is there a market maker around the VIX one day? Is one day?
So great question. Right now, it's just an indicator. So VIX 1D is just an index. It's not tradable at the moment. And so
okay, I didn't understand that.
We kind of rounded out the slate. I don't think a lot of people realize we have a 9-day calculation. We have the 30-day that has the futures on it that are tradable. We have a 3-month, a 6-month, a 1 year. So we have a lot of different time horizons using VIX. One day just rounded that out, given so much volume was happening in the near term. It's not currently tradable. I will say that the exchange is very much working on a way to make it tradable. The nature of what VIX is and how futures work on VIX, just introducing a future on the one-day number isn't really, to me, the best way to capture what people are looking at in this one-day move. So we are working on that. We really wanted the market to digest this, get the feedback, get the critiques, because they always come in, and then figure out, okay, now looking closely at how people are using this as an indicator, the risk they're trying to capture or trade around in their book, what could we do as far as a tradable product to help them really solidify that risk transfer tool? And we're getting really close on it.
Oh, cool. So what's your, being a trader and that sort of thing, what's your intuition on if when this thing does trade, using VIX versus VIX 1D? Does it seem like the VIX 1D is more of a buy against VIX or not, or the opposite?
It's a great question. It's funny. I actually, a lot of what happens in 0DTE is overwriting strategies. We see a lot of credit spread trading in 0DTE. And I think VIX 1D can be an interesting indicator as to credit spread timing in a way. When you're looking at that overwrite and where is the absolute level of 1D, what sort of daily events are coming into the market as you're kind of overwriting relative to that 1 day 0DTE trade. When it comes to 1 day versus 30 day, I don't know if you'll ever really see a buy one, sell the other type of thing. I think where it starts to get more interesting is the idea of, is there a directional trade that we can make on a 1 day setting while say buy the up move in the market and then sell downside puts against it in a way that you can kind of capture that convexity trade. I think you'll start to see people exploring things like that. And that's why we're trying to make sure that any product we send out there really allows people to capture those types of moves.
Okay, got it. Let me throw something up here for you. It's a little long, so tell me what you think.
End of your slide, maybe on the daily time series. Peaks and troughs. Sure. So I guess the point I'm mainly trying to make is that if you think of a 1 day event with a 24-hour window, like a Fed announcement, and you're trying to capture that with a 1 day VIX number, as soon as you get to that 24-hour mark before that announcement, the options you are now using in the 1 day VIX are capturing that event. So as you approach that event, it peaks, and then after that event, after that 1 day, so say the number comes out at 2:30 in the afternoon, it's a known quantity. So you're immediately going to see a tail off in vol because everybody now knows what the unknown has now become known. So you see all of these peaks where you see, like, as we approach, say, an FOMC announcement, volatility in the 1 day will creep up because it's at one point, all of that uncertainty for a 1 day event is pinpointed in the 1 day calculation. And then as soon as you know that event, it drops. Whereas a 30-day number is always looking at what is the expectation for volatility 30 days from now, which will always be much more of a trend following type of number because you're looking at a much longer horizon. You don't have that pinpoint accuracy around a particular binary event. So it's like, and what I use from binary is like, you don't know what the Fed's going to do, and then as soon as they announce, you know what they're going to do. It's black and white. And so that's kind of the difference of how the 1 day number has to take into account 100% uncertainty to 100% no uncertainty, whereas the VIX always kind of has an underpinning level of uncertainty.
Okay, that makes sense. And then hold on a sec. Let me get back to my comments. Let me toss this one up, see what you think.
Are 0DTE destroying the correlations that used to hold between individual stocks? It's a good question. I definitely think, when you change the time horizon for how you're managing risk, it definitely has an impact. Do I think it's destroying the correlations? Not necessarily, but I do think it does have an impact anytime you shorten this time horizon. So I think it's a great question. It probably takes a lot more than a minute or two here to go into it. We're actually heavily we have a bunch of correlation indices that Cboe calculates and puts out there. And we've been doing a lot of work on correlation. And we made a recent announcement not too long ago. We're working on a dispersion product with S&P. So a lot of interesting information coming out of that. I guess maybe it's a project for us to dig in a little bit on how zero DTE might be impacting that.
Okay, got it. Well, we'll just keep getting questions. I'll just put it up there.
Sure.
You can't get out this easy, Rob. Sorry. I'm keeping you here.
So it seems like VIX1D volatility will be. So it does. I mean, news does happen 24/7. The idea, where VIX1D I think becomes very interesting is kind of unknown known events that are taking place. So we know when a CPI number is coming out. We know when FOMC announcements are going to be made, so forth and so on. So having, watching trends around how volatility reacts. And remember, the VIX is literally just extracting information out of the market. It's the market's expectation for what they're pricing into vol. That's why I like it so much. It's using option prices. So it's not Cboe setting the vol. It's the actual market participants committing capital setting the vol. And so when you can look at that in small chunks around market events, you can start to build theories or investment strategies or however you want to look at it and use that data. It just becomes that. It becomes extra data points to me to structure your trading strategies.
Got it. Cool. So what about zero DTEs in individual equities? Is that around the corner, do you think?
I think we have a ways to go. Mainly, I think there's challenges with it. I think you have a physical delivery versus a cash delivery challenge. That's something that I don't think it's easy to get around. I think you have just an industry capacity challenge as well. But more than anything, I think it's that daily moves around things like corporate earnings events or takeover events. Like you have a nature of how that moves and a physical delivery that I think complicates it. So do I think we'll continually shorten time horizons for options trading? Yes. Do I know exactly what that looked like? And do I think zero DTE is coming in single names in the short term? I don't. I think we're a little ways away from it.
Okay. Got it. All right, good, Rob. Well, I appreciate all. That's really interesting stuff. I know you guys are always innovating over at Cboe. That's been terrific. I love everything you're coming up with. And the stat you gave on the percent volume of these zero DTEs versus regular, you say, I forget the number, but it's pretty big, right?
So when you said zero DTEs versus regular, yeah, I mean, 43% of our volume right now is falling in zero DTE. So, I mean, you can do the math. Think, 2.8 million contracts a day, roughly in SPX. 43% of that, 44% of that's fallen into zero DTE. So it's a big chunk.
That's amazing. That is amazing. Wow. Great
different
stuff.
Different market these days for sure.
Yep. I'm trying to think, if I were the market maker on the zero DTs, which way I would want to be. I don't think I want to sell them. And,
Well, the cool thing and where I think people really get, where there's been a lot of market media around the risk of inherent with it. One, and it's important to know that of the zero DTE trading, our calculations are roughly 70% is closed out before the end of the day. So it's not taken into expiration. It's actually closed out. And of the customer trades that are going up, like I said, I want to say 55-ish% are credit spreads. So it's another defined kind of risk spread. Really, you're looking at, call it a very, very small percentage, which is what I would call outright shorting. I actually call it less than 5% of the options from customers that are coming into the market are just outright shorting. It's all really defined risk trades. And that's in line with all of, think of the defined outcome funds and how much growth they've seen. People are getting more sophisticated and learning how to use options to define the investment scenario they want. And I think it's super interesting. And it's as we've seen, this has really been zero DTE definitely was kind of the biggest thing for, call it, the last 30 years to change how you're managing that risk term structure.
Got it. Cool. Yeah, I've been watching it closely. We have a good number of folks who like to trade those. So it's very interesting stuff. I really like it. So, all right, Rob. Well, thanks. That was awesome. I appreciate your input. Great presentation. Really interesting stuff.
Awesome. Well, yeah, thanks for having me. I always enjoy coming in and speaking.
Perfect. All right, Rob, have a great rest of the week. All right. So I think we're going to close